The tablet tonight be a little bit more tethered to it just because my external mic, I didn't charge it, but we can still use the system mic. Okay, so I'll probably be a little closer to the computer just to pick up the audio properly. Okay, so let's just go ahead and continue our discussion, which we really started in Chapter 4 of inventory. And remember, we talked about inventory in relation to our retail entities. Okay, so we talked about service entities. When we start talking about inventory, we're talking about a merchandising inventory company. We're talking about a retailer. We don't talk about manufacturers much in the financial class, but you probably recognize some of these terms from your managerial class, in which we start talking about things like raw materials. We start talking about items like our work in progress, our finished goods. You probably recognize those terms from your managerial. Those would be relevant if we were talking about managerial accounting. In financial accounting, we assume that those items have already been manufactured. They're delivered to our business as finished goods, and we simply start to sell our inventory as finished goods. Okay, so that's what we'll be doing here as we've gone through and looked. Remember, we talked last time about two systems, perpetual versus periodic. Most companies will use the perpetual system these days because they simply can scan the barcode, etc., and keep track of their inventory that way. Okay. However, we are going to need something about the periodic system, primarily in that periodic system can be used to help a company to recover potentially what the cost of goods that might have been destroyed are, and that we're able to back into our ending inventory, maybe using something called a gross profit method. And we'll talk a little bit more about that. We'll get into that period. We haven't talked about it yet tonight. Okay. Okay, so we take physical inventory, and we take physical inventory in the periodic method so we can count and see what our ending inventory on hand is at the end of the year. Now you look at that and you say, okay, well, taking the physical inventory then must be simply an accounting procedure so we can count up and see what our inventory is. But even if we were using a periodic system in which we updated our cost of goods sold and our inventory after each sale, we would still, and after each purchase of inventory, we would still need to count our inventory periodically to make sure what? That it hasn't been stolen, right? So it's not just a accounting function. It is also a matter of making sure that we have control over our inventory. Okay. Okay, now again, if we have goods in transit, determining ownership, and remember we said last time that if we have free on board shipping point, that means that title transfers as soon as the goods are picked up by the common carrier and they are picked up by the purchaser. Okay, so as soon as the purchaser picks those goods up, then they take possession. Those items would be included in their ending inventory, even if they had done what? Had them picked up, say, on December 28th. They didn't arrive until, say, January 5th. We would still consider that part of the purchaser's ending inventory. If it's free on board destination, title doesn't transfer until what? Until the goods actually are received by the purchaser. So take that same scenario where the goods are shipped on December 28th and they don't arrive until, say, January 5th. If it was free on board destination, those goods would be included in the seller's ending inventory. They would be excluded from the buyer's ending inventory. The seller, of course, would not recognize a sale for those items, right? Okay, so all of that we talked about last time. All right, good. So goods in transit should be included in the inventory of the buyer when public carrier accepts the goods from the seller. Goods reach the buyer. Terms of the sale are free on board destination. Free on board shipping point, right? Whoops. Out go the lights, right? So it's free on board shipping point. Okay. All right, good. So we talked about that last time. You can see a question there. I don't know to what extent I'll get too heavily into that on the on your exam, but there's a potential question like that. Okay, good. Now, if we have goods on consignment, what happens here? Goods on consignment, after you finish the BCPA program, you pass the CPA exam, you get your CPA and all that, you're going to have this empty feeling in life, right? And you're going to decide to write a book. And the title of the book is going to be Mothers Don't Let Your Children Grow Up to Be CPAs, right? And so you'll go to, will Barnes & Noble still be in business then? So you go up to Barnes & Noble and you say, hey, I want to sell this book in your store. Barnes & Noble looks at that title. They say, no way, no thank you. You say, please, I want to be a paperback writer, right? So what happens? They say, okay, they take pity on you. They say, you can leave the book on our premises. You can leave the book on our premises, and if it sells, we'll remit the funds to you, and we'll take a little piece of the action. We'll take 2% or something to cover us. At that point, those books are out on consignment. The end of the year comes. Should those books be included in your ending inventory or in Barnes & Noble's ending inventory? They're included in your ending inventory at the end of the year because Barnes & Noble didn't purchase them from you, right? So in that situation, you're the co-signor. Barnes & Noble is the co-signee. When we have a consignment arrangement, the goods are included in the co-signor's ending inventory. They are excluded from the co-signee's ending inventory. Okay? Okay, good. Let's take a look at inventory costing then. Okay? And when we cost our inventory, we talked a little bit about the physical items that are included in our inventory, didn't we? Right? Items out on consignment are included in our inventory, free onboard shipping point, free onboard destination. All of that was looking at the physical items. But what is the value we should assign to the inventory? So the first thing we have to figure is what is our cost of the inventory. Now, there is one method called specific identification. I gotta remember to stay close because I don't have my microphone. Hello, hello. Okay, so we have to sit here and we have what? We have this specific identification. The specific identification, we cost each item as it is purchased, as it is sold. Okay, item by item. This is typically the case for higher cost items, say vehicles, that sort of thing. Okay, now we also have what we call cost flow assumptions. With cost flow assumptions now, what we do is we just assume that the goods go out in a certain order, even if the actual flow of goods is not that order. The three methods that we're going to talk about are first in, first out, last in, first out, and then something called weighted average. They're calling it average cost here, weighted average, average cost. They're synonymous terms, okay? All right, so let's first look at specific identification, right? When I look at the specific identification, I'm like, were they a couple when they walked in and now they broke up or something? I don't know. They're going opposite directions here. But what happens? We have these items, these TVs. One is 700, one is 750, one is 800, right? The 751 is still in ending inventory, isn't it? Okay. And the cost of goods sold are these two that are being sold. 700 plus 800 is 1,500, right? So specific identification is a piece of cake, isn't it? You simply what? Keep track of the cost of each item. As you sell it, you take it to cost of goods sold. And as you buy those items, you bring them in at their cost, and that's what's in your inventory. Okay? Okay, good. Now you come over and you take a look at the cost flow assumptions. Now, you know, they give you this percentage of which companies use which methods or what percentage of companies use these methods. What's wrong with this graphic? What's wrong with this graphic? What's it missing? What would you like to see here? Huh? I'd like to see a source, okay? When you're looking at something like this, you should always look for the source, right? If they really want us to believe this, they should have given us a source. I mean, for all I know, this was some alcoholic that did this, you know, in their spare time or something. So I'm not sure why they didn't give us a source. Would have given me a lot more comfort with it. But when you take a look, they're saying that what? Most companies will use first in, first out, okay? And then what? A smaller number of companies will use Lifo. a smaller number of companies will use weighted average, and then they have this other category. And I don't know how reliable this is, okay? So even though I don't know how reliable it is, let me pontificate an explanation out on this, okay? Which is first in, first out is probably the easiest method for a company to keep track of their inventory, because it is usually in concert with the actual flow of goods. If we're at the store and they're selling us milk, they're probably going to try to do what? Sell us the items that they just purchased right away, right? And they're going to want to keep older items back in inventory. Last in, first out, very few companies sell in that order. Very few companies sell the latest thing that they added to inventory to you. They want to get rid of what? The old stuff first, right? And keep the newer stuff longer. So why would any company use Lifo? Why would this percentage be so high? Well, again, we can select a cost flow assumption, keyword there being assumption, regardless of the actual flow of goods. We can choose whatever one we want. And companies will choose Lifo because it has certain tax advantages. Now, the problem with Lifo, you say, well, then why doesn't every company choose Lifo? The problem with Lifo is what? It typically doesn't match the actual flow of our goods. So we're literally going to have to do what? Keep a separate accounting that's sort of using the pretend flow of the goods versus what? The accounting that would be showing the actual flow of goods. And so there has to be a significant enough tax advantage for a company to choose Lifo. That's why that percentage is down a little bit more. Weighted average basically tries to approximate basically what Lifo could do. So some companies might go ahead and incur the higher cost for weighted average, which isn't as bad as Lifo, but it's not as good as a tax advantage. Okay. All right. So these are the different methods, and you can see the percentages here. And let's talk about first in, first out. Okay. Cost of the earliest goods purchase are the first to be recognized in determining cost of goods sold, and it often parallels the actual physical flow of merchandise. Now you can go ahead and put next to that that is an advantage. That is an advantage of FIFO. Okay, so I could ask you on your exam, what is an advantage of FIFO? And one of the advantages is it matches the actual flow of goods, so it's pretty easy, isn't it? Okay. Okay, now what happens? We're going to pretend like we're going to, you guys ever been to this store? Anyone here ever been to Safeway? Do they have Safeway in Stockton? Yeah, they have one that I know of right there on, all things are on Pacific, right? Safeway, okay? And what happens? We sit here and we have, back in the back, we have the milk fridge, don't we? You ever been to Safeway and gone to the milk fridge? All the way in the back? No? Okay, this example is going to be lost on you if you've never been to Safeway, okay? So I'm assuming you have, okay? All right, so what happens? You go to the milk fridge, and what happens? Who's this? Okay, this is you, okay, and you're going to get some milk, and you see the milk fridge, and they have the milks in the front, don't they? Why has this pen started looking like it's trying to give me a heart monitor here? I don't know why it started doing that, okay? So we're sitting here and we have the milk fridge, and I don't know, I guess Safeway is going to charge us $4.25 for those milks. They charge us, or their cost, I should say, is $4.25. That's their cost, and they're going to charge us, say, $5. I wish that thing would stop doing that. What is wrong with this thing? So they're going to start charging us $5 for these. But they paid what? $4.25? Why did they charge us $5 if they only paid $4.25? They want to make money, right? Okay. And so when they purchased these milks, they went ahead and they purchased them at say, I don't know, say 6.1. Okay. Now, of course, they're going to what? They're going to buy some more milks to sell, and maybe the cost is rising of those milks. So these are going to be 450 now. Can't blame that on the pen. These are going to be 450 now. Okay, and let's say they buy those on 615. And then they go ahead and they buy some more milks, don't they? And because they don't want to run out, so that's going to be 475, and they buy those on 630. So the Safeway own trucks? You bet you. You don't get out of their way, they will run you over. Okay, Safeway's got a huge trucking distribution, don't they? Okay, so here's the Safeway truck, and the Safeway truck is delivering the milks, aren't they? Okay, now, what does first in, first out assume? First in, first out assumes that you will come over and you will grab this milk and you will put it into your cart. So you're going to grab these 425 ones and put them in your cart. How much are you going to pay for them? $5. What's the matter, Veronica? You don't think you buy those ones, the 425 ones? You're going to reach in the cart and grab the 425 ones, right? I'm not reaching the cart, but reach in the fridge and grab the 425 ones. What do? You reach over here and grab them? Okay, what does Safeway do? Change the date on the dairy products to make sure it's not. Doesn't matter. I don't care if you climb back there, get on the truck with this guy, go back to the cow and get the milk. It doesn't matter. This is a cost flow assumption. So we're just assuming, it doesn't matter the actual order, we're just assuming first in, first out. The stuff that they got way back in June 1st is the stuff that you're going to buy, right? Okay? So that means that our cost of goods sold is going to be what? Cost of goods sold is going to be what? $425, and our ending inventory is going to be how much? That was $475? Huh? Our ending inventory is $475? Those things are still sitting in the freezer, aren't they? So when Safeway does their inventory, they're going to assume that those 475 ones are still back there, right? Okay? Okay, good. Now you come over and let's see what they tell us about first in, first out. Nothing very good. Okay? So let's take a look right here. Okay, a major advantage of Fifo method is that in a period of inflation, the cost allocated to inventory will do what? Approximate its current cost. So what happens? If this truck were to roll over accidentally on these milks and crush them, these 475 ones, how much would it cost Safeway to replace these? Cost them $475, wouldn't it? So ending inventory pretty much is approximating the replacement cost. So when you look at their balance sheet and you see $475 per milk, that's pretty much what they cost them, isn't it? Okay, so that's an advantage of Lifo, isn't it? Is that an advantage of Lifo? Right here? Advantage of Lifo is that what? It approximates the, okay? The current cost. A disadvantage of Lifo. I mean FIFO. No, FIFO. It's FIFO. Did I say Lifo? FIFO. A disadvantage of FIFO. Disadvantage. Is that cost of goods sold does not reflect current cost. I'll read that back to you because it's got all the stupid lines in there. Disadvantage of FIFO is that cost of goods sold does not reflect what? Does not reflect current cost. Is that a disadvantage? What's happening? We're saying that our cost of goods sold is $425. Meanwhile, if we had to what? Replace those milks to sell them, we'd have to pay $475 for them, wouldn't we? Okay. So if you think about it, in a period of rising prices, FIFO is doing what? It's giving us a better picture of our ending inventory, but a worse picture of our cost of goods sold, isn't it? Okay? Okay, good. Now, that is our FIFO example. Let's go ahead and let's take a look at LIFO, last in, first out. Okay? And cost of the latest goods purchase are the first to be recognized in determining the cost of goods sold. Now, a disadvantage of LIFO is what? It seldom coincides with the actual flow of goods. Most companies are more like that example we just had, Safeway. They're going to sell you the older milks first, right? Okay. Now, what happened? They say exceptions include piles. Okay. So what's going to happen? Well, one time I was going to have some decorative rock put in my backyard. And I'm one of these kind of guys that says, just put them in. I don't care. Just put them in there. Do whatever you want. I don't care. Just, make it look good. And when it came to the decorative rock, they said, no. You must come to the rock place and pick it out for us. And I'm like, well, I'm thinking to myself, why do they want that? And then it hit me that they probably had the experience of what? They went and picked out some rocks and put them all in someone's backyard. And then the person went, oh, no, take those out, right? And it's probably much harder to do what? Dumping the rocks, you can do that happily, right? But taking them out is somewhat drudgery. So they said, no, you got to come with us. So I'm like, okay. So now here I go to this rock place. And all of a sudden, I sit there, and I'm a counting head. I say, oh, okay, here's our LIFO inventory. And that what? Well, when they get a delivery of rocks, what happens? The delivery of rocks are dumped on the top, aren't they? Right? And so these old ones, say the $4.25 per pound or however you price rocks, are down here at the bottom. Okay? And then what? Then we've got these, what, $4.50 ones in the middle? And then we have at the top the what? $4.75 ones, don't we? Okay? And so when we have at the top these $4.75 ones like this, here come my guys that are going to do the rock work in my backyard. What do? They take off the top, don't they? So when we take those, we're taking the $4.75 ones, aren't we? Okay, so cost of goods sold is going to be what? $4.75, isn't it? Ending inventory is going to be $4.25 because those are still stuck down there on the bottom, right? Okay, now you're sitting there saying, well, so only rock companies do this? Again, guys, what? It doesn't have to be the actual flow of goods. It's a cost flow assumption, isn't it? Cost flow assumption. Okay. So what's happening now? When we look at our last in, first out, and the balance sheet effects, a major shortcoming of FIFO is that what? In a period of inflation, the cost allocated to ending inventory could be significantly understated. Isn't that true? Right? Because they're saying, hey, $4.25, meanwhile, it's $4.75. Right? Okay. An advantage of LIFO is cost of goods sold reflects current cost, doesn't it? What are we saying? Cost of goods sold reflects current cost? Cost of goods sold reflects current cost. What are we saying our cost of goods sold is? $4.75, and those rocks are currently costing them what? $4.75, aren't they? Okay. So an advantage of LIFO is that, no, I don't want to restart anything. I don't want to install anything. Okay, and so what happens? Our advantage of LIFO is cost of goods sold reflects current cost, but our ending inventory is going to be understated, isn't it? Okay. Question? Okay, good. Now you come over and let's take a look at the tax effects of LIFO and FIFO. Okay? And they tell us that what? In a period of inflation, FIFO will do what? FIFO will give us a lower cost of goods sold. Therefore, it'll give us what? A higher net income. Higher net income, more taxes, right? FIFO gives us a higher cost of goods sold, a higher cost of goods sold, lower cost of goods sold, right? The 425 ones are cost of goods sold. A lower cost of goods sold, lower cost of goods sold equals what? Higher net income. Higher net income means what? More taxes, doesn't it? Okay. Lifo, on the other hand, in period of inflation, will do what? Will give us a higher cost of goods sold. Higher cost of goods sold means what? Lower net income. Lower net income means what? Less taxes, doesn't it? So most companies would be happy to pay less tax, wouldn't they? So how come most companies don't use LIFO? Well, think about it. It seldom coincides with the actual flow of goods, right? So while you're having an inventory system that has to keep track of how your goods are actually going out, in the meantime, you're sitting over here and sort of having this second system that's doing what? Pretending that the goods are going out in the opposite order. That is costly to run a parallel accounting system that is what? Different from the actual flow of goods. FIFO is easy. You're reporting flows with the actual flow of goods, right? So that's why more companies use FIFO, but some companies will choose LIFO. It's worth it to them for the tax savings. And the companies that it's worth the tax savings are usually very big companies, oil companies, that sort of thing. It's worth it to them to go ahead and incur the extra cost of having an accounting system that follows LIFO, even though the actual flow of goods may be a FIFO method. Okay? Okay. Question?
Why is it just an inflation?
It's just in inflation periods because we're basically sitting here and comparing the two, the LIFO versus FIFO. And so if we have a period of inflation, then these higher cost items are going to cost of goods sold, aren't they? Okay, if it's a period of deflation, it'd be the opposite effect in that what? We'd have higher cost items down here and lower cost items would be going to our cost of goods sold, right? If it was a period of deflation, okay? So it's only in period of inflation when you compare FIFO to LIFO that you have this tax advantage from FIFO, right?
So for companies that doesn't have, like, if their products doesn't expire, would they be more inclined to do FIFO?
No, because it has nothing to do, Brianna, with the actual flow of goods. Okay, they just choose. It's an assumption. The rock company could use FIFO if they wanted, and Safeway could use LIFO if they wanted, even though their actual flow of goods is what I just drew up here on the picture. Okay, so they get to choose. They get to choose what method they want, even if the actual flow of goods does not go in that direction. Okay? Now, what happens here then? Well, there's a rule. There's a tax rule, okay? And the tax rule is that if a company uses the LIFO method for its tax purposes, then it has to use LIFO for its financial accounting purposes. Okay? So companies would want to use what? LIFO for tax purposes, the way we just talked about when they file their tax return. Okay? But what happens? When they're preparing their financial statements, they might be inclined to say, hey, let's do FIFO because it shows a bigger net income, so investors will like us better, right? Well, what the accounting standards say is, homie, don't play that. We are not going to let you sit there and do what? Report a bigger net income on your financial statements, a lower net income on your tax reports. There's too much double whammy on the advantage there. So if you choose LIFO for tax purposes, then you also have to use it for financial reporting purposes, right? Okay, that's called the LIFO conformity rule. Okay, now what happens here? Companies can switch from year to year, but the reasons that they switch from year to year have to be because it provides more reliable financial reporting. So we can't switch from year to year saying, well, this gives me a bigger net income this year. Let me switch to the other one next year. Let me switch to the other one this year. They have to justify the reason. And it has to be that it improves the reliability, the accuracy of the financial reporting. They have to convince their auditors that. And then when they change, what FASB requires is they report a cumulative effect of change in accounting principle. So they would have to go back to all prior years to which they use the old method and restate those statements using the new method. They have to figure out what their net income would have been under the new method, and then they have to make a cumulative effect adjustment to the beginning balance of the retained earnings of the year of change to see what the retained earnings would have been had they used the old method in those previous years. So yes, they can change from year to year, but it's not a walk in the park. Okay. Uh-huh.
So companies choose Fifo or Lifo just for accounting purposes for their inventory, correct?
Yeah, we're talking inventory here.
Yeah. So why don't they just keep track of like each like shipment and inventory, and let's say it's 475, and then for each, and they just account for it strictly for the price that they paid? Why do they have to follow one of those methods?
Well, you're talking about specific identification. They could do that, where they would just keep track of what item they sold you and what the cost of that item was. That's called specific identification. Now, two things. For milks, that could get a little cumbersome, although with the scanning mechanisms, maybe that's not that impossible. But they want to do this for what? Financial reporting purposes. They choose the method that they think works best for them. And for tax purposes, they're all over it, right? So it's the standard setters and the IRS that are what? Giving them an option as to the different methods that they can use to account for these things. And what FASB is saying is if you chose IRS's method of using Lifo, then you must also use it for financial reporting purposes. Okay? Now, what happens? What happens? Let's say I'm this guy over here. I'm in charge of the rock company. And I walk in and I say, rock company, you know, you could be doing a little bit better. And I'm the CEO that's going to improve your operations, and I'm going to get all kinds of stock options, etc., because I'm going to improve your operations, right? And so the first thing I say is, no more purchases of rock inventory. That's the first thing we're going to do. And so what happens? We stop purchasing rock inventory, and then the rock guy comes. Right, well, what's my gross profit right now? Before I show up, what's my gross profit? If I'm selling them for $5 a pop. Probably should have told you that. Sales price is $5. My cost of goods sold is what? $4.75. What's my gross profit? 25 cents, right? Sales price is $5. And my cost of goods sold is $4.75. So my gross profit's how much? Gross profit is 25 cents, right? Now, how about, God, that's annoying. How about if I sit here and I come in and I say, gross profit 25 cents? What's wrong with you people? I can improve that. First thing I want you to do is stop buying inventory. Stop buying inventory for a while. And so what happens? Well, the 475 ones get sold, don't they? And then pretty soon the 450 ones get sold. And now we're going to be selling what? Those bottom ones, those 425 ones. Okay? How much are we selling them for? Still selling them for $5. Now they're only costing us what? On our cost of goods sold, $4.25. I just instantly turned my gross profit. I tripled it, didn't I? Am I a genius? Am I a genius? Look at that. I just tripled my gross profit. Just what? Improved my net income, the whole works, just by doing this little thing, right? Okay? Now what happens? I get my bonuses, and then I head back to wherever I came from. Does the company have a problem? They're almost out of inventory, aren't they? And now what? Now all of a sudden we've got a period of rising prices. Maybe they're going to have to go and do what? buy the rocks for $4.90, and we're going to have a disaster on our hands with this company pretty quick. Meanwhile, I'm sitting back in the Cayman Islands going, ha ha ha, what's my next project? Right? Okay, so what happens? Lifo has a huge disadvantage. Write this down. Huge disadvantage. It is susceptible to income manipulation. It is very susceptible to income manipulation, isn't it? So do you think LIFO is a good inventory method? There's a problem there, isn't there? That's a huge problem. Companies can manipulate their income by the accounting standard that they choose. That's not good. That's not good. In fact, it is so bad that IFRS, International Financial Reporting Standards, says no. IFRS says no to LIFO. You cannot use LIFO under IFRS. International Financial Reporting Standards, the International Accounting Standards Board, said no, we're not going to let you use LIFO. No. Isn't that mean? Maybe that's what? Maybe that's smart. The international standards are sitting there and protecting investors from what? Being bilked by this kind of income manipulation, aren't they? So maybe they got a little better way of doing things, right? So why doesn't the United States just go ahead and sit there and say, you know what? We're going to adopt that part of our IFRS. That protects investors more. We're adopting that part of IFRS. No more LIFO. What happens if you don't use LIFO for financial reporting purposes? Can you use it for tax purposes? If you don't use it for financial reporting purposes, you can't use it for tax purposes. If you don't use it for tax purposes and you have rising prices, you're going to have a higher net income. You're going to what? Pay more tax, aren't you? Do companies like to pay tax? No. Did I say big companies like LIFO? So big companies will go to Congress and they'll say, if you allow the United States to go over to the IFRS rule of no more LIFO, the terrorists have won. They'll say whatever it is that they have to say to make it seem like it's the worst thing that has ever happened, right? Right? Okay? In fact, if you think I'm joking, I was looking around, doing a little bit of looking around on this a while back, and what had happened was President Obama had put into his budget that they were going to eliminate LIFO as a good inventory method for tax purposes. They were just going to go ahead and do it. This is the accountant's way of doing what? Increasing taxes when nobody's looking, right? And so what happens? There's an entity called the Lipo Consortium. And the Lipo Consortium's whole role was to make sure that LIFO was maintained as a good inventory method in the United States. Now, let me say something. You're all coming out of Berkeley and you're going to be heavily recruited and you're going to get a lot of opportunity. If you find yourself on the LIFO Consortium, I want you to have a personal moment and just check your priorities, okay? And make sure you're in the right place, okay? But there was literally a group that fought that, and it did not go through in Obama's budget that way.
Is there an academic backing for LIFO or no? Like, what is the academic? Even if it's just like false, like what is
well, the academic backing is that it gives us a better picture of our cost of goods sold, right?
But it doesn't, though, right?
Oh, it does, because right now we're putting in the cost of goods sold those 475 ones, so we are getting a better picture of net income, aren't we? So that's why I went through and we did a little yin and yang thing, you know, here's the advantage of LIFO, disadvantage of LIFO, advantage of LIFO, you know, and it's one of these kind of things, but IFRS looked at that and said that one disadvantage, the fact that it's subject to income manipulation, we've seen enough. No more. We don't care about this. Scales have tipped. We're going to get rid of it. But in the United States, we keep it, and it's mainly because of the tax consequence.
So let's say if we're in deflation, like maybe in Japan, then like total just will be like the other way around, right?
Well, first of all, Japan doesn't use IFRS, so Japan uses their own sovereign accounting standards. Japan's system is almost like a cash system as opposed to a accrual system. Okay, I just wanted to put that out there. And I actually went to Japan with the CPA review course because a lot of people want to take the U.S. CPA exam in Japan now. And you know, there was a lot of talk during our meetings there. Will you ever go over to IFRS? And it was sort of like maybe someday, but not very soon, right? Okay. But yeah, if you had a period of deflation, you would have the opposite effect. Periods of deflation, though, are relatively brief. Okay, and usually the inflation comes back. But yeah, if you had deflation, that would be the case.
Then during maybe a deflation period or a certain fast cycle.
I don't think so. No, those methods are there, Lifo, Fifo, and they'll pretty much stay there with it. It's just making a wholesale change that completely eliminates, I don't know if I should call it wholesale, I mean, I guess it would be a well thought out change, but taking a major change that completely eliminates one of the methods is something that will be resisted. Okay? Question? Okay, good. Now we have these methods up here, and we have average cost. And I'm going to show you average cost as part and parcel to the in-class example. You'll see that it is the easiest method. So, probably should have handed these out before. Let's take a couple seconds to go ahead and hand these around. I'll do one stack down here in the lower, in the theater seats, and then one up here in the balcony seats. Okay, if you get done, maybe pass them up. Okay, and I'm going to end this for a second. I'll keep those. And there are going to be two examples that I know I had up here. So this is annoying. Let me find them. Okay, we'll do it this way. Okay, so is this the thing you have in front of you?
Yes.
Okay, so let's just go ahead and let's practice a little bit more with this now. And you take a look, and they tell us here that during the first year of operations, if it's the first year of operations, what's our beginning inventory balance? Zero, good. And Little Buster's Company has purchased its entire inventory in 3 batches as follows, okay? And they give us the amounts, and then we say 4,000 units in total were sold, 3,000 units were, 4,000 units in total were sold. And for right now, guys, I want you to, do you have that on your paper?
Yeah.
It's crossed out on your paper?
Yeah.
Okay, so I just want to cross that part out. I don't want to do that right now. We'll deal with that a little bit later. I don't want to do that part right now. It's too much, too fast, okay? Okay, so we have sold 4,000 units, and they bought these units. So they bought a total of how many units? 9,000, okay? And so they have available for sale 9,000, and then they sold how many? They sold 4,000, so that means that ending inventory consists of how many units? consist of good of 5,000 units. Excellent. Okay, 5,000 units in our ending inventory, right? With me so far? Okay. Now, in this, I'm going to ask you to calculate the, oh, hello. It's my own example. Okay, and so there's that right there, right? Now, what I'm going to ask you to do is give me the ending inventory and cost of goods sold using FIFO, LIFO, weighted average. We've already had an example of FIFO and LIFO. We'll say weighted average for last, right? Okay, so we come over and we take a look at our cost of goods sold, and let's do FIFO first. And so we say that our cost of goods sold is 4,000 units is what we sold, didn't we? First in, first out, we're going to take that batch one, aren't we? Did I put some dates on there on your paper?
Yeah.
So what do you got? Like when I did it, it was April last time. It was what, 4/1 or something? 4/1. Dates of purchase I'll put over here. 4/1, 4 what? 15 and 4/30.
Yeah.
Okay, so which ones do we sell first? First in, first out. We sell those, and we sell all 4,000 of those, don't we? So 4,000 times 425. Do I know my cost of goods sold? 17,000. Is that a piece of cake? Okay. Then what? Then I've got 5,000 units left in ending inventory, don't I? 2,000 of those were at 450, so that's what? 9,000, right? And the remaining 3,000 units are at 475. That's those right there, the 430 ones. They're in the back of the freezer still, right? And so you add those two numbers together. That's 14,250. You add the 9,000 to 14,250. Do I know my ending inventory? Easy enough? Okay. Okay, good. Now you come over and let's do Lifo. Shall we? Okay, how many units did I sell? I sold 4,000 last in, first out. Now what? Well, I'm going to first sell you 3,000 of those 475 ones, right? Right, so I sell 3,000 under Lifo at 475, right? 3,000 times 475 gives me this 14,250. I still need 1,000, don't I? So I go up and I look and I'm like, okay, well, I can take 1,000 of these 450 ones, can't I? There's 1,000 of those. 1,000 times 450, that's 4,500. So my cost of goods sold is going to be what, right here? 4,500. So my cost of goods sold is going to be what? 14,250 plus the 4,500. Right? How many items in ending inventory? 5,000. There's still 1,000 of these left, aren't there? Because I only sold 1,000 of them. So 1,000 times that 450 is going to give me 4,500, and the remaining 4,000 to bring me up to the total 5,000 are those ones sitting at the bottom of the pile, these 425 ones, right? Right? Okay. I add those two numbers together. Is that my ending inventory? Okay. Okay, good. Now you come over, and I said we also are supposed to do what? Weighted average method. Okay, weighted average, guys, is the easiest of the methods. If you thought Lifo and FIFO was easy, weighted average is the biggest piece of cake you've ever seen. And that we simply do what? We simply take the total units was 9,000, right? And then we simply extend the number of units times the price per unit to get the what? Cost of each one of those batches that we bought. Add all that together. That then gives me the total cost of all the units that I had available for sale this period. I divide that by the 9,000 units, and I come up with a cost of 4.47. And the reason I do that is if you just put 4.47, you're not going to get the number. It has to be the irrational number that comes out of that. 4.47, whatever it is, okay? You take that number, and since I sold 4,000, I take that number times 4,000, that gives me my cost of goods sold, doesn't it? And since I have 5,000 units in ending inventory, I take that 4.72, and I multiply that by the 5,000 units that are sitting in my ending inventory. That gives me my ending inventory under weighted average, right? Which method's the easiest? Weighted average, a piece of cake, isn't it? Okay. Now, I just costed my inventory, didn't I? I came in with the cost of it. What's the t-shirt that I keep saying I should get you? I guess that t-shirt's not going to be much of a big seller. Huh? Accountants do it with journal entries. I can sit here all day and show you how to calculate these numbers, and it doesn't matter unless we can sit here and come up with a set of journal entries to account for this, right? We've got the numbers, but we need journal entries, right? Ready for some journal entries? Hey man, want to do some journal entries? Okay, ready for some journal entries? Okay, all right. So I just started business, didn't I? Oh, what method am I using? Periodic or perpetual? Okay, if you insist, I'll start with perpetual. Don't think that gets you off the hook for periodic, though. But let's start with perpetual. And so I bought some inventory, didn't I? And when I bought the inventory, I would have done what? I would have debited my inventory, and I'm not going to do it a batch at a time because I don't want to be here all night. So I would have debited my inventory for a total of $40,250 eventually. Okay, so $40,250 is a debit to inventory, and I'm just going to assume they paid cash for it. Could be accounts payable, whatever. That's not the point here. Okay, so I debit inventory, I credit cash, don't I? Is that the perpetual method? Hello?
Yes.
Okay, so my inventory got debited for $40,250, so it has a balance now of what? $40,250, right? With me so far? With me so far?
Yes.
Okay, good. Then I start selling my inventory, and I guess we're doing Fifo first. So this is Fifo up here. I want to get rid of this pen, but I don't want to be violent about it and throw it. But I want to get rid of it because it doesn't write, and I don't like pens that don't write. What's going to happen when I go to hell? They'll say, "Oh, okay, John, go and teach classes. You like to teach, right?" And I'll be like, "Oh, thank you." And I'll go into the room, and all the pens won't write. So what happens? We go ahead and we have this Fifo inventory. We debit that. Now we start to do what? We start to sell the inventory, don't we? And so when we sell it, we debit our cost of goods sold. And for the first batch, we're going to debit our cost of goods sold for what? For $425 when we sell those? Huh? 425 times the 4,000. Good. We're going to do it. Oh, I'm looking at the wrong one, though. We need to look at, what, Fifo? Okay. So Fifo, good, guys. You already figured out that the cost of goods sold is $17,000, isn't it? So I debit my cost of goods sold for $17,000, and I'm going to go ahead and credit what? Inventory for $17,000. Okay? And when I credit my inventory for $17,000, what's left here? It better be $21,500, isn't it? I mean, $23,250, right? Hello? $23,250. So did I just do this with journal entries? Okay, so my ending inventory is 23,250. My cost of goods sold is 17,000. Good. That is what, Paul? Do I debit cost of goods sold because it's an expense? Is that what you said?
Yeah.
No, I debit cost of goods sold because it's cost of goods sold. It is not an expense, it's cost of goods sold, but it acts like an expense. It reduces, it's subtracted off of my sales to give me my gross profit, and then my gross profit has a deduction of expenses, so it lowers my net income, right? But so you give me a trick question. I don't debit it because it's expense, I debit it because it's cost of goods sold, and it's going to be reduced off of my. Somebody else had that same question. Did you get my email back? It's kind of frustrating, right? Because they say, cost of goods sold is cost of goods sold. It's not an expense, but it acts like one, right? Okay. Okay, good. So we go ahead and we just did this with journal entry, didn't we? Okay. Now, we used Fifo and we used Perpetual, didn't we? How about periodic? How would we do this with periodic? When we purchase inventory, we don't debit inventory, we debit what? Purchases for $40,250 and credit cash for $40,250, right? We debit this purchases account, not the inventory account. And then we have to go at the end of the year and we have to sit there and we have to count our inventory, don't we, to see what we have left? Under the periodic method, we have to count the inventory to see what we have left. Now look, I don't have a room over here where I can go and count the inventory, so I'm going to peek at Perpetual, just for our academic environment here in the classroom. And I know that my ending inventory is what? Is going to sit there, and it's going to be these 5,000 units that under FIFO, I know I have valued at what? 23,250. So I'll count up, there's 5,000 units left using FIFO, I'll value that at 23,250, right? So what will I do? Remember the Catholic priest formula? It's what? Beginning inventory is how much? 0, since we just started business. We add the purchases. How much were the purchases? 40,250. So my goods available for sale is what? $40,250. Is that my goods available for sale? Beginning inventory of 0 plus the purchases, so available for sale is 40,250, right? My ending inventory, I'd have to count it, 5,000. I would use what? The FIFO cost flow assumption to value those 5,000 items, and I would discover that my what? Ending inventory is 23,000. What is it? 22,250. Hello? 23,250. So my cost of goods sold is how much? 17,000, isn't it? And you're like, yeah, John, I know. We just calculated that. But what? We had to do the count of the inventory to know that there were 5,000 units in there and they're periodic. Under Perpetual, we know how much our cost of goods sold is and our ending inventory is at any moment, right? Because we're updating our inventory and our cost of goods sold after each sale and each purchase. Question? Question? Okay, hang on. We're going to go over Lifo falls now. Okay? We're okay with this? Okay, let's do Lifo. And is it better to write it somewhere else? Is this better or is the sideboard better? Okay, so okay, so what happens? under Lifo, we'll do the perpetual first, and when I purchase the inventory, I debit inventory 40,250, and I credit cash, right? So that part's exactly the same. Now what? For Lifo, FIFO, that's exactly the same. Okay. Okay, good. Now what happens? Now I go and I sell my inventory, don't I? And so my cost of goods sold, we've already figured out for Lifo is going to be what? Cost of goods sold for Lifo is 18,750. So I'll debit my cost of goods sold 18,750, and I will credit my inventory, right? 18,750. Okay, and when I tee up my inventory now, it originally was 40,250. Now I just credited it what? 18,750. So the balance in here is what? And I kind of already know that the ending inventory balance should be 21,500. Check my math. 21,500. Right? But now I just did it with journal entries, didn't I? Nothing happens in the accounting system unless I sit here and make these journal entries for it, right? Okay? Okay, good. Now that gave me the perpetual method. If I am going to use now the periodic method, this is Lifo over here. If I'm going to use the periodic method, what am I going to do when I purchase the inventory? I'm going to debit purchases, good, for 40,250. I'm going to credit the cash, for 40,250. And then I'll go ahead and I'll do my little formula up here, which is what? Beginning inventory was 0. My purchases were how much? Purchases were 40,250. My ending inventory, and again, I'm going to peek here. I'd have to actually go and do what? Count the 5,000 items and cost them at using Lifo, right? Okay, but when I do, I will come up with this, what? 21,500 for my ending inventory. And so my cost of goods sold then, when I calculate it using the periodic method, is going to be, and I already know that my cost of goods sold is 18,750, right? Hello? Okay, so the same calculations we made here, guys, all I did was what? Use those calculations to calculate my ending inventory, use those calculations to make my journal entries.
Is it periodic? So is your next journal entry, like you put your cost of goods sold and then you would credit your purchases?
Oh, thank you, you're right. We're not done yet, are we?
No.
That's a good point. We're not done yet under the periodic method in either case. FIFO or Lifo, right? Okay, because what's happening? Good observation. I've calculated the cost of goods sold in each of those scenarios, but I haven't yet done the journal entry to bring that cost of goods sold onto the books, right? So yes, you are correct. You're 2/3 correct. In this case, I'm going to do what? I'm going to debit cost of goods sold for 17,000, right? I'm up here now, I'm doing the FIFO. This is the FIFO one, right? For the FIFO one, I'll debit my cost of goods sold, 17,000. I'm going to have to debit Alyssa inventory because what? I haven't debited inventory so far in the periodic method, all I did was debit purchases and credit cash, right? So I never set up my cost of goods sold, right? So I'll debit my inventory, and I know that my ending inventory is this 23,250, isn't it? Is that my ending inventory? Have I brought that on the books now? I have my ending inventory, I have my cost of goods sold, don't I? And then I'll go ahead and I'll credit what? And you're right, I credit purchases for the 40,250. I don't need purchases anymore. Purchases is not something that's reported on my financial statements, on my income statement. It is simply a what? An account that sits there and serves as a vehicle to allow me to calculate my cost of goods sold, right? So I get rid of purchases, bring the inventory on the books, bring the cost of goods sold on the books. Great question, okay? I forgot to mention that. Now, okay, now, or you're just pulling your hair out, right? That's all it is. Okay, don't worry, it's not a big deal. Okay. All right, so then what happens? Then you sit there, and I'm going to do the same thing for Lifo, right? So for Lifo, and it's just different numbers now, I will debit cost of goods sold for Lifo for what? Huh? 18,750? I'm going to debit inventory for, what was my ending inventory? 21,500. And I'm going to credit purchases. Same journal entry, different numbers, right? For 40,250. Same accounts, just different numbers because it's now Fifo instead of, it's Lifo now instead of Fifo. Okay? Okay, now, we are not going to do the journal entries for weighted average because you'll go into a coma, right? It's the same journal entries, different numbers depending on what system we're using, right? Okay? Notice, guys, we had a period of rising prices, didn't we? We had a period of rising prices, and so what happened? Our cost of goods sold under Fifo was what? 17,000. My cost of goods sold under Lifo was 18,750. Did it work? Right? My ending inventory under what? Under Fifo was 23,250. My ending inventory under what? Under Lifo was sitting here at, where was it? Ending inventory was 21,250. So I had a higher ending inventory under Fifo, didn't I? How did I get the same number? Yeah, I had a higher ending inventory under Fifo, didn't I? Okay. That's that 475 milks in the back, right? Okay, so what we're going to do is we're going to take a break right now. Okay, it's a good time for a break. And we are going to continue on into year 2 of this example. And I'm going to hand you year 2. I got a handout for you for year 2. So we'll get into that. Okay, and we'll quickly look at the journal entries for year 2. And then we're going to look at the quizzes for chapter 5. Okay? All right, guys. I'll see you in about 10 minutes. Okay?
Just to clarify, Perpetual, those would be the actual numbers. In Perpetual, you have the real numbers.
I'm not sure I'm following the question. The difference is that for Perpetual, we actually we update our inventory and our cost of goods sold after each purchase. But periodically, we have to wait till you count.
Okay, so periodically, estimation. These numbers would be different. They would be
The
estimated.
numbers are exactly the same because there was no difference in the order in which we bought and sold the items. If we had under Lifo, if we had sold some items before we before we purchase another batch, we have to use that. We have to use that more recent cost of Perpetual to get a different answer to periodic. That's only something that happens for Lifo. It doesn't happen for Fifo because first in, first out. You make the presumption that everything goes out for 25, or you just use that earliest cost that's in the system. So only Lifo results in different numbers for Perpetual. Okay, that makes sense. And we'll see some examples of how that'll work. This and put this up as I did chapter 4. You probably saw that. The only problem is the sound will be a little funky because when I step away from the computer, you get a lot more of the ambient noise in the room because I forgot my little headphones. But my voice carries. You should be able to hear it okay. Okay, that's a trait of growing up in Hayward. We learn to talk loud. Okay, so anyway. So let's go ahead and let's go into year 2 now, following this same example, and not same example because it's year 2 now, but the same set of facts. I mean, same company. And of course, I always remember to hand it to you after I start talking about it, right? So let's just go ahead and hand that. This is year 2 now. Okay. And I'll go ahead with the top row, and if there's any extras, hand them up or hand them down. Okay, so we go into year 2. Okay, and in year 2 now, we assume that the busters bought another batch of 7,000 units, and now they're paying $5 per unit for those items, and they sold 9,000 units. And again, I ask, what is the cost of goods sold? What is the ending inventory? And I ask it under the 3 methods that we've been talking about: weighted average, FIFO, LIFO, right? Now let's just go ahead and take a look at the calculation of the inventory that's been sold. We had a beginning inventory of 5,000, didn't we? Last year's ending inventory is this year's beginning inventory. We add the units purchased, so goods available for sale is 12,000, less the units sold is 9,000, meaning that we have ending inventory of 3,000, right? Okay, we're going to go through that same process, and this time I'm going to go ahead and start with weighted average. Thank you, sir. You're a gentleman. Thank you. Okay. How many extra credit points did I give you today? Just kidding. Just kidding. Thank you. I owe you one. You okay back there, Grace? I saw you jogging earlier. You looked healthy then. Weren't you jogging earlier? Weren't you jogging earlier? No. I looked out my office window and I saw Grace jog by.
Really?
Or were you just running from somebody?
I was joking.
Oh, okay.
I was getting my phone from my car.
Oh, okay.
Yeah, I'm
Okay.
getting old. Yeah.
I didn't say you were getting old. I did not say that. Okay, so what do we got? Okay. Cut, edit. Okay, so what do we got? So we've got what? We've got our beginning inventory, guys, and remember our weighted average cost was 447, wasn't it? 22222, whatever. Okay, and so I bring that in at 5,000 units. There's my beginning inventory using weighted average 22,361. I bring in the new cost for year 2, what I bought, 7,000 units at $5 per, right? So that gives me the cost of my new inventory, 35,000. I add those two numbers together, 57,361, and I divide that by what? The 12,000 units, which was the 5,000 units in beginning inventory, plus the 7,000 units that I just purchased this period, right? And I come up with a new weighted average per unit, don't I? For year 2, okay? and that comes out to about 4.78. And I think that one's a little closer, that you don't have to use all those irrational numbers to get it right. But since I sold 9,000, the fact pattern told me, then my cost of goods sold is the 9,000 times the 478, or 43,021. And my ending inventory, we said there are 3,000 units left. I multiplied that by my weighted average cost. That gives me the ending inventory. So again, weighted average is piece of cake, isn't it? Okay. Okay, good. Now, let's look at FIFO. And I have my I have my cost of goods sold. And I sold how many units here? 9,000? I sold 9,000 units? Okay, so what do? Well, there's no more of those batch 1 ones. I sold them all last year, didn't I? So all 4,000 of those are gone? Okay, so I now start going to batch 2 from year 1, and I sell all of those at $450 times the 2,000 gives me $9,000, right? Then what? Then I've got to go to batch 3 from last year, and I need to sell 9,000 units. There's only 3,000 of those left, right? The entire batch 3 is left, and I sell out of all of that. That's at $475. That gives me $14,250. Since I sold 9,000 units, I still need what? 4,000 more, and that's going to be what? 4,000, and all of those are from batch 4 of this year, the $5 ones, right? Right? Okay, so I extend that out, add those numbers together, the 9,000 from batch 2, the 14,250 from batch 3 from last year, the 20,000 from batch 4 from this year, add that together, that gives me my cost of goods sold now for what? For FIFO for year 2. My ending inventory is the 3,000 units that are left, and they're all those $5 ones, aren't they? So it's 15,000. Okay. Okay, good. How about our buddy? Question? How about our buddy Lifo then? Lifo, last in, first out. The first ones I sell are those ones on the top of the pile that I just bought, right? So I just bought what? 7,000, all from batch 4. So I'll sell 7,000 of those. Now I need 2,000 more, don't I? Now remember, at the end of last year, what had happened? I had sold 1,000 of the batch what? Batch 2 ones and all the batch 3 ones, right? So I've still got 1,000 of those batch 2 ones left, don't I? So I take the 1,000 of those batch 2 ones at $450, that's $4,500. And now I do what? Now I've got 1,000 that are going to be left from, that I'm going to have to sell, I should say, from batch what? From batch 1 of last year to bring me up to the total of 9,000. 7,000 all from this year. All of the ones from batch 2 that were left from last year, and now I'm going to grab 1,000 of those 4,000 that were left in batch 1 from last year under Lifo. And then what? Then my ending inventory is 3,000, all the batch 1 ones from last year at $425.
Is a mistake. Isn't it 35,000 plus 3,000?
Huh?
Or other total?
Oh, yeah, thank you. The total is right. It's just the number is wrong. Thank you. It's 35,000 right here, right? That's what you're saying, Peter? But if you add them together, that's a good catch. But if you add them together, you get the right number, okay? You know, you see what I'm saying? The total is right. That should be 35,000. Thank you. It's a typo. Okay. Question? Grace?
Why units from batch 2
Huh?
Why units from batch 2 and the other units? Or 1,000, 1,000.
Okay, well, I'm trying to sell 9,000 units, right? Okay, the first 7,000, which are all I have in batch 4 from this year, they're gone, right? And at the end of last year, I had sold out under Lifo 1,000 of batch 2. I sold 1,000 of those, and 1,000 were left over, weren't they? If you look at last year, right, under Lifo, in my cost of goods sold under Lifo, I sold 1,000 from batch 2, and then there was still 1,000 left because there was 2,000 in batch 2, and I sold 1,000 of those. So when I come into the next year now under Lifo, I need to sell 9,000 units, right? And I sell 7,000, all of my batch 4 ones. They're all gone. Now I go to the next batch that's there. Batch 3 is completely gone because I assumed I sold that all out last year, right? So now I got to go to batch 2, and I still had 1,000 left. I do those. I still need what? 1,000 units for to bring me up to the 9,000. Those come from batch 1. So now I'm down to 3,000 units in batch 1, and those are my ending inventory. Okay? Okay, good. Now, I want to look at the journal entries, okay? And, sorry. See what happens when you're nice to somebody? You miss the whole exam. Okay? There might be some extras there too, okay? So what happens? This is on B courses, guys. I thought I printed it, but then I didn't have it. But let's just look at it here. It's just simply giving you the journal entries under perpetual versus periodic, right? Okay? So when you look at perpetual, let's look at that first. You don't have this in your handout. Notice that what? There's my beginning inventory, and I'm using that from the previous example. Is that Lifo or Fifo? 23,250. That's Fifo, right? Was my beginning inventory 23,250? I'm showing you the beginning inventory. And then I'm just going ahead and I'm doing the journal entries. Debit inventory 75,000. I'm assuming credit accounts payable. When I do that, I get a new balance for my inventory, don't I? And under perpetual, something we didn't do last time is you have to what? You have to update your inventory after each, and your cost of goods sold after each purchase, right? And we did them by batches. And so what happened? We went ahead and we first sold, our cost of goods sold was 9,000 for that first batch. That was using the price, the 425, or excuse me, the 450 ones, and it was what? It was 2,000 of those at 450. That gave me the 9,000. So I debit the cost of goods sold. I credit the inventory. And I'm just showing you the posting over there. And I do it for each one, don't I? And I just show you the posting. So this is exactly what we did last time for year 1, isn't it? It's just different numbers in the journal entries. Okay, what did I do? I sold under Lifo. Fifo, excuse me. We're doing Fifo there. Under Fifo, I sold 2,000 units, and I sold them at 450. That was 9,000, right? And when I sell those, I do what? I debit my cost of goods sold right here, and I credit my inventory, right? Then what? Then I sold another batch, didn't I? And when I sold that next batch, I sold them at what? 3,000 units at what? At the 475 amount? Where am I? I should be supposed to be in year 2. Huh? Year 2, I sold 3,000 at what? At 475, didn't I? So that's 14,250. Right? All I'm showing you is what we just did. I'm just showing you the journal entries for that. So I debited the cost of goods sold, 14,250. I credited the inventory. I'm just showing you the journal entries for those numbers that we had on that spreadsheet that I just handed out to you, or whatever you call that thing, those tables I just handed out to you, right? And then what? Then I did the same thing for the last batch, debited the cost of goods sold, credit the inventory. I'm just showing you those journal entries again, and I'm posting them, right? Okay? Now, if you were, and I just did it a batch at a time. Now, if you were going to do what? If you were going to do your periodic inventory method, what would you do? Well, you would have sat there and you would have gone ahead and debited purchases for the entire amount, right? The 35,000, and credited the accounts payable. And then what? Yeah, you would have had to have done the Catholic priest thing, which would have said what? Beginning inventory plus purchases gives me goods available for sale minus the ending inventory, which we said was 15,000. That's the 3 1,000 units that were ending inventory under FIFO, $5 each. That gives me the ending inventory. That gives me my cost of goods sold, right? And then I would go ahead and proceed to make the journal entry here, which was what we, Alyssa, you asked me, hey, haven't we left something out here? We would debit the cost of goods sold, credit the purchases, and here we credit the inventory because the inventory came down from what? From 23,250 to 15,000, didn't it? So we have to bring the inventory down now by crediting it for 8,000. Did the inventory come down? It came down from what? From 23,250, what it was at the beginning, down to 15,000. I need to bring it down, don't I? And I bring it down by doing what? It should come down because I ended the year last year with 5,000 units. I'm down to 3,000 units now, right? At any price, that's probably going to cause my inventory. I wouldn't say any price, but in the prices within the range of what we're talking about, that's going to bring it down, right? So I go ahead and I credit it to 8,250 to bring it down. Okay. Question? Why are you guys looking like a spaceship? All I did, back up, you understood how we got the numbers, didn't we? Didn't you? Okay, then all I did on this spreadsheet is I did the same thing that I wrote on the board here. I did what? I updated my cost of goods sold and my inventory after each purchase, each sale under the perpetual method, right? Under periodic, all I did now is I set up my beginning inventory, right? Before it was 0, now it's 23,250, right? I add the purchases, which were 35,000 in this example, gives me goods available for sale, right? I subtract off the ending inventory, and you were all down with me when I sat there and I said 3,000 units at $5 a piece is 15,000 for ending inventory, right? I subtract off the ending inventory. That gives me cost of goods sold. It was the same thing I did over there, just different numbers now, right? Right? Okay. Now, what happens? Now, I have to close the purchases like I did before. Like Alyssa said, hey, what are you doing? You're not done, man. Get back there. So I credited the purchases here, right? I did what? I go ahead and I debit my cost of goods sold for what I calculated my cost of goods sold to be, that number right there. And look, my inventory, I got to balance this journal entry, and my balance is for 8,250 that I have to credit it, and it's because I need to bring the inventory down from 23,250 down to 15,000, don't I? What did I say at the beginning of the class? I can solve any problem with accounting, can I? The numbers came down in the inventory. Credit inventory, now it's less. Isn't that beautiful? Okay? Question? Jesse, you had a question? Lifo was the first things that we had purchased. That's correct. It was the 5,000 units in inventory, was the 4,000 units from batch 1 plus the 1,000 units from batch 2. As the years go by, we will keep that first batch unless we sell out of that first batch. And then those would be all gone, and then we start making new Lifo layers. But yes, you're correct. Those 3,000 are going to sit there forever if we keep buying more and more items. Ending inventory value will be distorted. That was a disadvantage of Lifo. You are correct. Your sense is correct. That was a disadvantage of Lifo. The ending inventory isn't showing the correct values, is it? Yeah. Yes. Yes. Now, we're not going to learn that in this class, but there's a method called dollar value Lifo, which makes a price level adjustment. which helps deal with some of that problem. But you are correct. Just straight value, LIFO has that valuation problem. Okay. There's something else I was going to say there. We have that valuation problem under straight LIFO. Oh, remember I talked, you asked me about change in accounting? Who asked me about how often can they change the accounting principle? Who asked me that? You guys asked me that? Okay. How frequently can you change the accounting principle? What FASB does is they provide an exception to that rule if you change from any other inventory method to LIFO. Because think about it. If you change to LIFO, now all that stuff, you were using FIFO, now you change to LIFO. Now all that stuff that you said that you had sold and was gone, now you're saying in LIFO it is what? It's still here. And if you're Macy's and you've been in business since 1885 or something stupid like that, how would you possibly come up with the stuff that is supposed to still be here since 1885? You can't, right? And so they give you an exception there. They call it impractical to estimate, and they just allow you to change from any other inventory method to LIFO, and you're just going to have to disclose in your footnotes that you've had this change, however you have not calculated the effect of changing the accounting principle, because it's impractical to estimate. Now, sometimes my CPA students would say, well, why wouldn't everybody just say, hey, impractical to estimate, man? Well, you can't be laying on a couch when your auditors show up and say, you know, I tried and I couldn't do it. You got to show them why it's impractical to estimate. Paul, do you have a question? Okay.
Yeah, I'm thinking so. Can we actually let's say we're doing type 1, that's the example where just putting type 1, type 2, type 2, rather than inventory, that can we actually break inventory into type 2 smaller or type 1, type 2, type 2? So when we purchase type 1, and we credit type 1, then when we're actually debiting into this, we just credit type 1. Credit type 1 first and then credit type 2.
Say that one more time. I know it's hard to do. It's funny. Now you know how I feel. Go ahead, one more time.
Can we break inventory like into smaller parts? So just break inventory into type 1, type 2, and type 3. That's all our inventory. And because we're doing cycle, we credit type 1 first, and one type 1 is completely gone, then we credit type 2, and one type 2 is completely gone. Then we credit.
Well, under FIFO, that's what we do. Now, in the perpetual method, we'll have a little bit of problem. We're going to look at a problem in the homework in the quiz here in a couple seconds, in which we're going to see what happens if you're using LIFO and you don't have batch 2 yet. Even though batch 2 is a later price, if you don't have it yet, you can't use it for your accounting, and you have to update your inventory and your cost of goods sold after each sale and each purchase, right? So under that circumstance, you would be forced under LIFO to still use the batch 1 price. Then when you buy batch 2, now you have a later cost in the system, and you would go ahead and use the batch 2 cost. So what you described is exactly what we do under FIFO no matter what, because we always go with that earlier price. So out of all of batch 1, all of batch 2, all of batch 3. And it's not about so much the size of the batches as it is what the dates is when you bought them, right? When we get to LIFO and we're using Perpetual, we're going to see a couple problems in a second, then we'll be forced to use the batch 1 price because that's the only price in the system. If that happens, you use that until you get a new price, and when you sell that next round, you use that later price.
From year 1 to 2, why is inventory built in debit that way? Like how it's like cost of goods sold inventory debited and purchase credited and then the opposite.
Well, because the inventory balance went down from 23,250 to 15,000, didn't it?
Yeah, but didn't that happen in the first year?
No, the first year it went up. It went from 0 to 23,250. Right, it started at 0, so we needed to bring it up, so we debited it, and then in year 2 it came down, so we credited it. he's,
So it seems like Perpetual that we are all same countries, and when it's something like these things will not expire pretty quickly, it's
well, I don't know about you, but toilet paper expires pretty quickly.
Go ahead. I'm sorry. Not possible, and it just seems like it's just a switch, not real. In other words, this order comes in, whether it's Lifo or Fifo, that's what it's still being used out.
Well, we would have categories of inventory, right? So we'd have toilet paper, napkins, plastic forks, I don't know. All those inventory items, so we would have all of those different inventory items, right? We keep track of by type of item, right?
What I'm saying is the fund listed for the people, fund just for the people.
Okay.
We're just, literally
Huh?
talking numbers.
Are there barcodes on each item so you know what you sold and how it works each time you get a big basket?
For the Perpetual, the barcode we use that, yeah.
Yeah. Because I can see that you're trying to like, it seems like it's just like associate numbers instead of like actual items, right? That's what you're asking.
Well, if it's proof, if it's proof,
Yeah, there's a barcode, there's a sticker. So they can keep track of what items are sold.
I mean, if we're using the Perpetual system for each item we sell, it goes out, but we're confusing prices with the items, okay? So with the barcode, it might go out as the number of items we sold, so we sold 5,000 oranges, right? But we sit there, and if it's FIFO, we are going to have what? The first cost being the first ones out, right? So you guys are talking units, and what I'm talking here is the prices that we assign to the units. And it's based on how many we bought in each batch, right? So we bought 425 ones, we sold 4,000, we're using FIFO. Okay, we assume all of them are 425. If we're using Lifo, we still sell 4,000 oranges, but now we assume that what? 3,000 of them had a price of 475, so that's three, an example. And 1,000 had a price of 450, right? Going back to your way. Okay, so we're just assigning prices to these inventory items, and the way that the goods are being sold might be being kept track of by the barcodes, right? Now that's under Perpetual. We would update everything as we sell them using the prices that are in our accounting system. Under Periodic, we would wait till the end to do it, right? Okay. All right, so let's go ahead then with all that. And can I close this now? We're done with this? Okay. And I can close this? Get this out of the way? Okay, and before we actually go into that, I think we still have a couple things left from the slides. So let's do the test after we have completed the slides. So we did our little in-class examples. Okay, we talked about, guys, don't forget the balance sheet effects, right? Okay, that we talked about before. We also had what? We also had a discussion of the does it have to do here? Okay, slide. Okay, I guess it's this one. So let me go ahead and hide the attribute. Okay, so we had the tax effects, right? Okay, and then what? The cost flow method often parallels the actual physical flow of goods is what? FIFO mirrors the actual flow, right? Like those notes, okay? Okay, good. In a period of inflation, the cost flow method that results in the lowest income tax is Lifo. Good, right? Rising prices. Okay, period of inflation. Okay, now lower of cost or market. In this example, when we went through and we used our cost, our 425, our 450, our 475, we were just saying this is our cost, right? But what FASB tells a company is under the rule of conservatism, when you do that extension for the units, you have to use either the lower of those cost numbers that we were using or the market numbers. So we would go through that whole process using the cost numbers, using Fifo, Lifo, weighted average. But then we would have to see, well, would our inventory been lower if we had used the current market value for those? And if it is, then we have to write our inventory down to a lower amount, okay? So we come over and we call our market our replacement cost. And they say this is an example of the rule of conservatism. And so we come over, guys, and if we have to report our inventory at lower cost or market, and our cost is 60 and our market is 55, which is lower? Market. I don't think I'm putting a question like this on. You guys will make this into a peanut butter sandwich, okay? Which one is lower, cost or market? Cost or market? Cost or market? The only thing that's stupid about this one is who buys DVDs anymore, okay? But other than that, it's very easy, right? Okay? If you're waiting for deeper meaning, stop, okay? After you've gone through everything that we just went through with the cost for LIFO, FIFO, weighted average, you have to compare what is the actual market for these. And if the market has what? Fallen for these items, then what? You would go ahead and you would use that lower market. Lower cost or market. Okay. Inventory, guys, is a current asset, right? Your inventory will probably be gone in about a year. So it's a current asset. Cost of goods sold is subtracted from sales, and we get what out of that? Gross profit. Okay, good. Okay, now let's take a look at some analysis of inventory that we can do. Okay, and what we're going to do is something called inventory turnover. Inventory turnover. Okay, and every time I talk about this, I think of Apple turnover, right? So we have what? We have inventory turnover, and what we do is we take our cost of goods sold and we divide it by the average inventory. That gives me my inventory turnover. And then if I want to figure out how many days my items stay in inventory, I take my 365-day year and I divide that by my inventory turnover. Okay? So you come over here and we give you this information in which we have our cost of goods sold, and we divide that by our average inventory. Our average inventory is what? Our beginning balance of our inventory plus our ending balance of our inventory divided by 2. Now, a lot of times I'll get students to say, John, why do we divide by 2? Well, there's 2 numbers and we want the average of those 2. So we divide them by 2, right? And it gives me the average over the year, beginning plus ending, 2 numbers, add them together, divided by 2. That gives me my average inventory. So what they're telling me here, guys, is they sold out of their inventory 9.1 times, didn't they? If my cost of goods sold is $315,000, my average inventory was the average of these 2 numbers, then I must have sold out of my inventory 9-something times, right? Right? Okay, I sold that thing 9 times. Now, if there's 365 days in a year, then 9 divided into 365 means that the days that my item stayed in the inventory is 40 days. Turned it over. How many times during the year? 9 times, right? I sold it out 9 times. And my what? My days in the year is 365. 365 divided by 9 means it was 40 days, right?
I was going to ask about
Yeah.
like round up. Kind of like if you buy like 1.5 an apple or 1.3 an apple, do you still? You know,
Oh, well, you can round it to 9 if you want. 9's right. Are you upset with the 0.1?
No, like just when you know it's like lower than 5, it just goes down to 5, but you can't really have.
Well, you can round it to 9. It's not a big deal. Or you can do it 9.1 if you want. No, I mean, it could have been 9 or 40 point. It's kind of nerdy. 40.1 days. They would have been a good company if they weren't for that 0.1, right? Okay, so yeah, you can round them to 40 days, right? Not 0.1 days. Is that what you asked?
No, okay, so if you have if you're last month's 1.3 an apple, right? You can't do you wouldn't say 1 apple, you'd say 2 because you can't have a third of an apple.
Mm-hmm.
Nobody's supposed to have that.
Okay, but this is days. It's not units. You sold it 9.1 times, so it's how many times you sold out your inventory. You did a 0.1 of a time. Now, where this idea of rounding up would come in when you guys are doing in your class the break-even analysis, and the break-even in units is 3.7 units. You can't sell 0.7 of a unit, so the answer to that question is what? 36. 35.7, it's 36, right? Here, this is the number of times, and 9.1 times is a good number, and 40.1 days, a little tiny more than 40 days, right? Okay? Okay, so and I wouldn't round that up to 41. Okay? Now, is this good or bad? Peter?
How does that difference?
I'm sorry, subtract the end inventory.
Right? 36,000
It's plus. It's adding them two together and you're taking the average of the beginning and kind of, hey, it's a rough approximation, guys. I mean, don't build a bridge using this kind of analysis. Okay? It's a rough approximation of, what our average inventory is. But it's a very crude analysis, right? But is this good or bad? 40 days. Huh? Depends on what my inventory is, right? Alyssa, if this is a sushi restaurant, that's horrible. Don't go there, okay? If it's what? If it's real estate, that's very good. That's incredible, isn't it? Okay, so it really depends, right? Okay. Let's go ahead and talk about the gross profit method. Gross profit method is going to be taking our net sales minus what we think our estimated gross profit will be. That gives us our estimated cost of goods sold. Once we know our estimated cost of goods sold, we can back into our estimated ending inventory. Why would we want to estimate our ending inventory? Why can't we just count it? Why can't we just count our ending inventory? Why do we have to estimate it?
For like future purposes, like if you want to know if you need to order
Okay. I could see that. That's not what I was thinking, but I could see that, huh? Okay. Yeah, you don't want to count it? That's what I'm thinking. We had soap. I won't do toilet paper in the example. We had soap, and a flood came and washed all the soap away, right? And so now what was our ending inventory before the flood, right? Okay. And so that's what goes on in this question here. We have what? We have our net sales, and we have an estimated gross profit of 30%. Now, where do we get that? That's based on our past experience, right? What our gross profit percentage is. We look at previous years. And so our estimated cost of goods sold then is 140 if we think we have a profit of 60, right? Once we get the estimated cost of goods sold, we know what our beginning inventory was before the disaster. We add in our purchases. We would know what that was. It was 160. And then what? If we want to figure out what it was before we got a chance to count it before the flood, we would simply pull in our estimated cost of goods sold. The difference is our estimate of our ending inventory. And I think all the reasons that you gave might be good reasons really to try to use that. Okay? Okay. So, I want to take us to the quiz. Now, there were 2 quizzes. I'm going to do this one first. I'm going to do this one first, and then we're going to get into Chapter 8. And if we have time, we'll do the second one. If not, we'll do it on Thursday along with the practice midterms that are up on B courses. But I want to do this one because I think this is a little more of a variety from what we've already learned. The other practice quiz is very much what we've already talked about, using that Busters kind of information, which we've already learned from that. I think what we're going to learn. Okay. So this one starts out with this neta shutters, whatever, and they give us information, and they say physical count of the merchandise on November 30th reveals that there are 45,000 units on hand. Assume a periodic inventory system. Assume that we're using specific identification method. Guys, this is the key phrase here. That's why I highlighted that in yellow. If it's specific identification, and then they tell us that ending inventory consists of 10 units from each of the 3 purchases, what is the cost of goods sold? Well, if ending inventory consists of what? Of 10 units from each of the purchases, and then what? The entire 15 units are still here, then my cost of goods sold must be what? Must be 50 units from what? From the November 8th purchase, 20 units from the November 17th purchase, and 35 units from the November 25th purchase, because they told me there's only 10 left of those, and they told me all 15 of the other ones from that first amount are left, right? So to get cost of goods sold, I simply take those prices and multiply them times the numbers that I must have sold if there's only 10 left from each batch, right? And the 15 from the first batch. Okay. Now, you look at that and you're like, okay, so what accounting is this? That's reading comprehension, isn't it? That's more of a reading comprehension question than anything. Question? Okay, good. Let's go ahead. No? Let's go ahead and let's take a look at, we just extended that out. That's the 891. Let's look at number 2. Pappy's staff has the following information. And assuming that a perpetual inventory system is used, what is the ending inventory on a FIFO basis? Okay, so what's going to happen? It's a little hard to follow because I put these X's in here, so just pretend like you can still see that 10, you can still see that 60. Right, so we had 10 units in our beginning inventory. We purchased 60 units at $92, and then we sold how many? We sold 40. So what did we do? We sold all 10 of these, didn't we? Those are all gone, and we sold what? We sold 30 of these, so there's 30 left now, right? Did we account for that first sale? Okay. Now remember, we're looking for what? Ending inventory here? We're looking for ending inventory here. Then what? Then we bought 30 more units, and we sold 28, didn't we? So if we sold 28, we're going to take them all from this earlier purchase, aren't we? So now there's only 2 of those left. And we didn't sell any of these last ones. So when we do the inventory, it's 2 at 92. It's what? 30 at 95. The ending inventory is 3034. Let me say that again. It's 2 at 92, right? Because we sold what? We sold 28, we sold all but 2 of these, didn't we? When we went up there, so there's 2 at 92, and there's going to be what? All 30 of these at 95 are still left. We add those 2 amounts together, our ending inventory is 3034, right? Hello? Okay. Okay, good. Now, I just kind of threw this in. What is the cost of goods sold? The question didn't really contemplate that, but I just typed that in. What is the cost of goods sold now under FIFO? And so what happens? Well, we sold what? All 10 of these at 90. Then we sold what? We sold all 30 of these at 92, right? And then what? And then we've already seen that we then sold 28 of these to only have 2 left. So you add that up, that's the cost of goods sold, right? Okay? I know it gets scary when I'm looking at you. Looks like I'm going to come up there and just, but I'm looking because I'm seeing the not understanding thing going on. What's your name again, sir? Huh? Jesus, right? We're good? We sold what? Are we okay with this one up here?
Yeah.
So all I'm saying is what's the cost of goods sold? So under first in, first out, we sold 30 units in the, 40 units in that first, so we took all 10 of these, didn't we? And then to sell 30, we needed 40, we needed 30 more, didn't we? So we took 30 of those. So now we're left with what? 30 of those, right? Before I cross that out, we're left with 30 of those, and then when we sell that next 28, hey, we got 30 of these, don't we? So we take 28 of them, and now there's 2 left, right? I just showed you how to do the cost of goods sold. Go back to number 1. Okay.
So you sold 10, so from November 1st, it was 5 units.
No. Are you doing this one right here?
Yeah.
This one, the problem told me that there was 10 units left from each batch.
Oh.
10 units left from each batch. If that's the case, then I must have sold 50, I must have sold 20, I must have sold 35.
Why were there
This one right here? Number 2?
Oh, 30.
Huh? There was 30 left before I crossed it out.
Right.
There was 30 left, and then
And then you use it.
I used all of those for that you sell 28 on the first in, first out. Now you look at the next one, number 4 here, and it's the same facts, but now it's going to be what? Now it's going to be Lifo, isn't it? So they want ending inventory under Lifo. So what happens? Well, I go ahead and they tell me that I purchased, I had beginning inventory 10, I purchased 60, and then I sold 40, didn't I? So if I sell 40 under Lifo, it's those ones that I just bought, isn't it?
Yeah.
That's the only number I have in the system, so I have to use that number. That was the question we had. I have to use that number, don't I? So I take those out, and I take those out at 92. So if I sell all 40 of those, I have 20 left, don't I? Right? I sold 40 units on July 14th, right? The latest cost I have in my system is this July 5th amount, isn't it? So I take 40 of those. I take 40 of those. There's 20 left, isn't there? Okay. Then I have another sale of 28, but now don't I have a new cost in my system? Do I have a new cost here? I have a more recent cost here, so I use what? I assume that I sold all 28 from there, so now there's only 2 of those left. So if I do my ending inventory, 10 units at 90, 20 units at the 92, and I'm down to 2 units at 95, right? Okay? Okay, good. Uh-huh. Am I recording this? Yes, I am. The only thing is that you'll hear you'll hear my voice kind of drift away as I get towards the screen, but I think I talk loud enough and you can always pump the volume up. Just be careful when I come back, and then you'll be, ah! But you guys are used to that. Don't they do that with movies now? I hate that. The movie's really, really quiet part, so you turn that thing way up, and then they blow something up, boom, and then the whole house almost falls down. Like, ah. My poor dad comes running out, are you okay? Yeah, Dad, I didn't blow the house up. Okay, okay. All right, so you come over and you take a look at what? Assuming a perpetual inventory system is used, what is the, and all we're asking now is what? Oh, that is the one we just did, isn't it? Yeah, we just did it. Hello. So it was the 28 at what? At 95. What did I do up here? Okay. What are these numbers? This is for the next problem? Oh, okay, sorry. So I'm going to do, I asked myself. I screw myself up by putting this. What is the cost of goods sold, right? Okay. So I just typed that in. I used the same facts and I just typed in what is the cost of goods sold. So cost of goods sold is going to be what? Well, I sold what? 40 at 92, didn't I? Because that was the only system I had, the cost I had in my system. And then I did what? I sold 28 at 95, didn't I? Because I had that later cost when I sold those 28. Right? Okay. Uh-huh. That's correct. This is what it cost us to acquire these. This is our cost of the goods sold. I'm not being, I'm not trying to talk down to you. I'm just saying cost of the goods sold. Okay, now, again, we would then do what? After we do all this, we compare it to the market, and if the market is lower, we throw all this away and we use the market. Isn't that wonderful? But we have to first figure out what the cost is in order to compare it to the market. And then we'd use the market, if it's lower.
What exactly is meant by the market? Like what when you sell it for?
Market is what it would cost us to replace it. It's replacement cost. Okay? Now, under you, what it would cost us if we had to replace items that are in our ending inventory. Yes, so we value it at that replacement cost. It should be closest to that, but if we have a last batch in there that we get 5, but if we're sitting there and we're using some different method for costing those, then it could be different. So we have to bring it down to that lower market. Potentially, if we're doing that with items and with inflation, but that's a general inflation or inflation of prices, but it could be different for different items that we have, and there's different methods that we could be using. We could value the entire inventory. We could value it by category. We could value it by individual inventory items. Individual inventory items is going to give you the most conservative picture because you don't have opportunities for things to cancel each other out. The other thing that happens is we're going to have to sit there and we come up with that replacement cost. US GAAP gives me a market ceiling and a market floor. So when I use my replacement cost, I can't go over the ceiling, I can't go below the floor. And so my replacement cost is in the middle, I use the replacement cost. If my ceiling is in the middle, I use the ceiling. If my floor is in the middle, I use the floor. You use the middle amount for your market. So it gets a little bit, and I'm just telling you all that, that's not even in the test. I'm just telling you that it gets a little bit complicated as how you go about it. So for right now, our best bet is just to say if the market is the lower amount, use the market. If the cost is a lower amount, use the cost. Rule of conservatism. We have to write our inventory down to a lesser amount if it's less than. Okay? Okay, good. So let's go ahead and let's take a look at what... just in time. How timely. Let's look at this one. Okay? So we've got this. And guys, this is not a multiple choice question, okay? I don't think I'll give you something like this as a full-blown problem, but let's just take a look. And we have the cost when the units were acquired, and we have the replacement cost. Replacement cost is the market, and we're going to use the lower. So for the first one, what's lower? 20 or 19? 19. 45, 45, they're the same, so you use 45. 59.62, which is lower? 59, the cost. 40.36, what's lower? Market, and then you just simply extend them out. Lower cost or market. What are you thinking to yourself? How dare you ask me that question? You ask me that question, I'll make a fool of you. Okay, we're not going to do this one. Don't worry about this. Okay, question? Okay, good. Is that it for that one? Let's look at Depreciation, Chapter 8. Okay, so we're jumping a little bit. I mean, I would have liked to have gone through all of our current assets. After the exam on Monday, we're going to talk about receivables, note receivables, and account receivable. But we're going to jump to the fixed asset here and include that on the exam on Monday because this is a little bit more simple. Now, they give us an analysis here of fixed assets for different companies. And notice what? Southwest got a lot of fixed assets, don't they? Right? So they're a what? Heavily invested in fixed assets airplanes, essentially, right? Okay. Microsoft, they're more what? Intellectual property that they rely on, software, that sort of thing. So not so much on the fixed assets, right? Okay. Now you come over, and when we determine the cost of our plant assets, we use historical cost. Okay, we use historical cost, and we talked about that already, right? We bought a piece of equipment for $1 million or a piece of a building for $1 million, 20 years ago, and we're looking, we're saying, man, that building's worth $5 million. Now we still carry it at what? $1 million, right? Okay, now you come over, and we include all costs necessary to acquire the asset and get it ready for its intended use. So, if we have to transport a piece of equipment from Nebraska to California to use it, is that part of the cost of the asset? Can we use the equipment in Nebraska if our business is in California? No. Who wants to go to Nebraska, right? So what happens? That is part of the cost of that asset, right? Okay. How about if we have to affix it to the factory production line in order to use it? Is that part of the cost of the asset? We can't use it unless we fix it to our production lines, right? Okay, so all of those costs would be considered part of the cost of the asset. Now, we have to consider depreciation. And when we consider depreciation on an asset, it's nice and shiny new when we get it, and then over time, the value of this asset will depreciate, will go down, won't it? Okay, and then at the end, we will be able to salvage it, a salvage value. So if we bought this truck for $30,000, we're sitting there and saying, we think at the end we can sell this thing for $2,000, whatever, right? Okay. Now, when we look at the methods of depreciation, again, where's the source? Where's the source? I don't know. But what? I would say most entities would use straight line because it is what? Easy. Okay. When we deal with what? When we deal with declining balance, that's a variation on straight line. That's a little bit more difficult, so less companies would use that. The most costly method probably is units of activity, because not only are we going to have to calculate our depreciation, we're going to have to keep track of how frequently we use an asset, and that can get a little costly for us. So most companies would use straight line, and we're going to study all three of these. Now, we come over and we got this information, I guess, for that delivery truck that you saw going down drill before. Cost is $13,000. Salvage value is $1,000. 5-year life. We think that we can drive that thing for 100,000 miles. Okay? And we're going to use these set of facts for calculating straight line, units of activity, declining balance. Those are the three methods that I'm going to hold you accountable for knowing how to calculate your depreciation. Okay, so you go ahead and you take this this 13,000 for straight line. 13,000 minus 1,000, that's $12,000 is our depreciable base. We take that depreciable base and we divide it by what? 5 years. That means my annual depreciation is what? $2,400 per year, isn't it? Right? Now what do? I go ahead and, guys, sometimes I have students, not you guys, but they ask me, well, why if it's 5 years is it 20%? 1 divided by 5 is 20%. So I go ahead I take the 12,000 times the 20%. That gives me depreciation expense of 2,400 in year one, doesn't it? Right? And then what? My accumulated depreciation becomes 2,400, and so now the book value of the asset is 10,600. So when I were to prepare my balance sheet for year one is going to show what? Going to show the equipment. How much did I pay for the equipment? I paid 13,000 for the equipment, right? And then I'm going to do what? I'm going to show the accumulated depreciation. Accumulated depreciation is how much? 2,400. So I take the 13,000 minus the 2,400. So the book value, sometimes called carrying value, this asset is going to be 10,600. Right? Right? Okay, book value is 10,600. You see it right down here. Okay, now I come over and I just keep doing this, guys. And each time my accumulated depreciation goes up by the amount of my depreciation expense, doesn't it? Okay, my depreciation expense stays at 2,400 each year. It goes back to 0, and then it does what? It comes down to the 2,400. I mean, it goes up, I should say, by the 2,400. And it goes down back to 0, 2,400. It's going to be 2,400 every year. Okay? Okay, good. Now, if I purchase an asset in the middle of the year, then what? Then I will have a partial depreciation. I don't know about the middle, but during some point in the year, then I would take partial depreciation. So if I bought this asset in April, and you definitely need to count on your fingers for these guys, it's going to be what? January, February, March went by before I purchased that asset, didn't it? So instead of taking the full year's depreciation, I'm going to take what? 9/12. And so in that first year, my depreciation expense would be 1,800, accumulated depreciation 1,800. Then what? Then starting in the later years, I take the full year's worth of depreciation, right? And if it so happens that, by the end of, I still have that asset by the end of that last year, and I don't want to depreciate below my salvage value, then I would only take 3/12 of that. So I don't want to depreciate below salvage value. Okay? Okay, good. Now, we could use units of activity. Units of activity is the smartest way to use the depreciation. It is based on calculating depreciation. It is based on how much I actually use that asset. So if I use that asset a lot, I take a lot of depreciation. If I don't use the asset at all, would I take any depreciation on it? Maybe a little bit, because what? The winds of time will turn everything to dust, right? So I might go ahead and take a little bit of depreciation, but we'll just say for our purposes, don't use it, don't take any depreciation, right? Okay? So what happens? Again, guys, I take that depreciable base, the 13,000 minus the salvage value, I'm only depreciating the 12,000, right? But now instead of dividing it by the years, I divide it by the number of miles. And remember that first slide we said was 100,000 miles? So that's what, 12 cents a mile here? So I go ahead and I take that 12 cents a mile, and if I drive the truck 15,000 miles, that's a depreciation expense of 1,800. I would debit depreciation expense 1,800, credit accumulated depreciation 1,800. Isn't this the smartest way to do this? Right? Based on use? Why are you shrugging your shoulders? Huh? You mean like a hurricane? Okay, because if it's a hurricane, then we would consider that a casualty loss, and we would take that entire loss immediately because the hurricane wind blew it away, right? So we've got, where's my pen? Accounting will solve. Go ahead, give me a problem, and we'll handle. We've got an accounting rule to handle it. We would just write the whole thing off. at that point. Now, they used to call that extraordinary item, but they got rid of that. And so they just call it casualty loss. They don't stop talking about extraordinary item, but it's now, they don't have it anymore.
Is the solid value like over $1,000 or
You know, you should have some objective measure of salvage value, okay, and you know, maybe a manufacturer, you know, idea of the life or something, and then you might bring in your engineers and say, hey, what can we sell this for after? So it's, you know, it's an estimate. All of this is an estimate. Depreciation is an estimate. Your financial statements are full of estimates, aren't they? You might be sitting there thinking they're full of something. I don't know. Full of estimates? Okay, that's what you want to call it, John. Okay, so what happens? There's all kinds of estimates in the financial statements. So you know that thing on the mirror, it says objects in the mirror are closer than they appear on the car mirror? That's telling you, don't just wheel out in traffic, you know. It's an estimate, right? Well, guess what? Financial statements have that same warning. But it'll say, these are full of estimates, and don't stake your whole life savings on what we put in these financial statements, right? So this is all an estimate. Okay? Okay, so we have this 12 cents per mile. Now what happens if we sit here and we drive the truck more, we have more depreciation, don't we? Right? Now this one so happened to work out perfectly. Isn't that cute? That it worked out perfectly that we used it right up to the salvage value, right? We would stop depreciating at the salvage value. We want to keep that salvage value, even if we drove it more. Even if we drove it more, because we've depreciated it completely down, and we're going to keep that salvage value. See what the estimates do to us? You're sitting there saying, but John, you kept driving it. It depreciated more. What do you want me to do? I capped it at 1,000. I'm not going to depreciate it any further than that. And I stopped depreciating. Okay?
So let's keep on driving like 11,000 miles. Do we record 11,000 or just 10,000?
Where are you getting 11,000? Oh, right here?
Yeah.
We would just go ahead, and even though we might have in our records that we drove at 11,000 miles, our depreciation would be 1,200. It would be 1,200. No, we drove at 11,000 miles, but the depreciation would be 1,200.
But my question isn't just the miles. Do we just write 10,000 miles and we just...
No, we'd write 11,000 miles because that's the number of miles, and we might want some cost, volume, profit data. We don't want to mess up our, you know, our operational data by saying it was we only drove it, 10,000. Let's go back and set back the odometer, so we want that to be accurate, right? But then we would only take 1,200 of depreciation. Yeah.
Why don't we want it depreciated below salvage value?
Because we use that the whole time to sit there and calculate our depreciation expense. And we start to get into what we can call change in accounting estimate. And if we had a change in accounting estimate, we have to now go, what are we going to do, go back, etc. Or just what are we going to do, depreciate it a dime a day, a dime a year now because we don't know. So rather than get all hung up and trying to go back, we just hang at that 1,000. And then when we ultimately sell the asset off, we'll take a gain or loss for that. Of having a salvage value greater than 0, is there a benefit to that? Well, you should do your best to come up with a salvage value. You don't have to have a salvage value. Okay, you should try to represent what you think the thing's going to be worth at the end. You don't have to have a salvage value. You can depreciate without a salvage value. And the quote-unquote benefit to having a salvage value that's greater than 0 is it would potentially lessen any gains that you'll have in future years when you sell it off. Is that a benefit? I don't know. But that would be really bad. Okay? Okay, so let's go ahead and let's take a look now at any question on, I know what I wanted to say about, remember we said very few companies use the units of production method? Because what, or units of activity method? We could do units of production, which is how many units will be produced by this machine, and we could use that as well. But is there, why do so few companies use this method when this seems like the most accurate method based on actual use? Right? Is that what you're going to say? They have to keep track of how many miles, right? And if you're Southwest Airlines and you got a fleet of airplanes, that's going to get a little tough, isn't it? Okay, my entrepreneurs, can you think of a way to get around that?
Nowadays, wouldn't it be not as hard because everything's on like computer systems that like automatically record every single thing?
I'm thinking there's got to be a wireless system somewhere that does what? That tracks how many miles, and at the end of the flight, the pilot goes, and it goes and uploads into the cloud how many miles he used, right? I'm thinking. Okay, so, yeah, so I would think it's not as tough these days, right? Yeah, okay? Okay, now you come over and you take a look at what? At my declining balance. But you should be working on that now, shouldn't you? To see if that's the case? If there's not such a machine? You should be looking to see if that machine is out there, right? That might be a good business to get into. Okay, so what happens? Double declining balance. What do we do here? Double declining balance is going to sit there, and it's going to accelerate our straight line. It'll accelerate our straight line, and if it's double, then it'll double the straight line. Now you could have triple declining balance, you could have 1.5 times declining balance, whatever, right? But in this class, we're going to assume what? Double, since that's the most common, okay? So, remember, when we took straight line, it was 20%. Double 20% is going to be 40%. Double 20% is, everybody, 40%.
Why are we still using the book value here rather than that depreciation?
Because there's the rules. Okay, we do not use the salvage value of this. Okay, however, we've got salvage value written down on a piece of paper, and we look at it every year to make sure that we don't depreciate below salvage value. So we don't use it in the calculation, but the rule is that we still what? Consider it, and we do not depreciate below salvage value. Okay? So we come over, and we take this what? We take this 13,000, Alyssa, without considering the salvage value, but we know that the salvage value is what was it, $1,000? That's $1,000, and we take 40% that first year, right? And that gives me 5,200. Okay. Then what? My accumulated depreciation equals my first year's depreciation. I have the book value. I take that 7,800 book value. See that 7,800 book value, the remaining book value, and I multiply that by 40%. That gives me my depreciation for year 2. So my depreciation for year 1 plus my depreciation for year 2 gives me my accumulated depreciation, doesn't it? 13,000 now minus my accumulated depreciation means I have, or you could take 7,800 minus 3,120, whichever makes you feel better. And that gives me what? 4,680 as my book value, right? Right? I take the previous book value minus the what? Current year's depreciation, that gives me the new book value, doesn't it? Or you could take what? You could take the original cost minus the accumulated depreciation. Both are going to give you that 4,680. I take that 4,680, now I bring that over, I multiply that by 40%. That gives me my depreciation for what, year 3 here? So now what? Now my accumulated depreciation goes up by that 1,872. I could take 4,680 minus 1,872, or I could take 13,000 minus 10,192. Either way, I'm going to get 2,808, right? I take that remaining book value, 2,808. I multiply that by 40%. I get 1,123. 1,123 now brings up my accumulated depreciation to 11,315. I take the 2,808 minus the 12,123, or the 13,000 minus the 11,315. That gives me 1,685, right? I take the 1,685, I multiply that by 40%, and when I do, I get 674. So now what? Now 1,685 minus 674 means that I have an accumulated depreciation now of 11,989. 11,989 minus 13,000 minus 11,989, or 1685 minus 674, however you want to do it, leaves me 11,11 at the end, right? 1,011. So what should the depreciation be in 2020 now? $11. $11. I do not depreciate below salvage value, right? So even though I didn't use the salvage value in the calculation, I make sure that I don't depreciate below the salvage value, right? Okay? Now if you look at double declining balance, notice what? My depreciation is more in the earlier years and less in the later years, right? Do you think that might approximate the way you use an asset? You get a new machine. You're going to use it a lot or a little bit? You're going to use it a lot. That poor little machine starts to get a little older. Pretty soon you're saying, okay, truck, just make local deliveries. We're not going to have you doing long deliveries because they're going to break down halfway out there, right? And so you might actually use an asset like this, right? And so declining balance is sort of trying to approximate the units of production method or units of activity method, isn't it? And it's not as costly because we don't have to sit there and invent a wireless system to keep track of all of our use of our asset, right? Okay. Okay, good. Again, guys, if you put the asset into use during the year, you go ahead and you do what? You only take a portion of that, right? Now that's applicable to straight line and declining balance. Units of production, it's not units of keep saying units of production. They're synonymous. Units of production, units of activity. It's not relevant because you're basing it on how much you actually use it during that period. Okay, and notice again, our guys did not depreciate below salvage value, right? They call it a plug. In accounting, sometimes when a number just has to be to make the whole thing work out, they call that a plug. Be careful because people will tell you that in a journal entry that an amount is a plug because they can't explain to you how they got it. There are very few true plugs in accounting. And I see in textbooks all the time the authors will put plug and I'm like, no, it's not a plug. We can figure it out, okay? This is a true plug. This is a true plug because you don't want to depreciate below the salvage value, right? That's what I meant. Okay? All right, good. Now notice this chart here. Straight line is straight. And what? Declining balance a lot in the earlier years and less in the later years. And you see how it's kind of trying to approximate the units of activity. We use it less in its later years. Okay. All right, now retirement of assets. What happens here? Well, now we've got this asset that we've depreciated, right? And if we depreciated it entirely down to its what? Bare salvage value, and then we just went ahead and junked the machine, what would we do? We would go ahead and we would debit, and this one I guess strike what I said about salvage value. This one assumed that there was no salvage value. Remember we said there doesn't have to be. So the accumulated depreciation equaled the equipment, and if you just junk it after that, you debit the accumulated depreciation to get rid of it. You credit the equipment to get rid of it. Is this whole thing gone? Okay. Okay, good. Now, what happens if we still have that asset? So it's a fully depreciated asset, and, well, it's not fully depreciated, is it? My what? Accumulated depreciation is $14,000. My equipment is what? $18,000. So it wasn't fully depreciated, was it? Okay. But what happens? I go ahead and I give it away. Well, if that's the case, don't I have a loss? I credit the equipment. I debit the accumulated depreciation. I have a loss. If you think about it, guys, this is a catch-up for my depreciation that I should have been taking all those years that I didn't take, right? I should have been taking more depreciation expense each year. Depreciation expense is an estimate, and we what? We solve all that. When we finally sell the thing, we go ahead and we take a loss for that. Where do I report this loss? No, the accumulated depreciation is a contra asset. The equipment is an asset. You said it on the income statement? It says on the income statement it's a loss. What did it say down there? Oh, the income statement. Okay. It says. At least I'm not reading the slides, Steve. Okay, it said that. So it's a loss, isn't it? Okay. And I report on the income statement. Where on the income statement? Under my expenses in my what? Non-operating section, right? I have revenues minus expenses gives me operating income, and then what? Then I have my non-operating items, which include gains and losses on the sale of equipment, because I'm not in the business of selling my equipment, right? Okay. What about interest revenue, interest expense? Is that down there non-operating as well? Okay. Okay, good. Now we come over and we sell the plant, and we sell and we get some money. Somebody gives us some money, or not plant, probably equipment, and somebody gives us some money. If the proceeds exceed the book value, that's a gain. If the proceeds are less than the book value, that's a loss. Okay, so let's just go ahead and let's take a look. The furniture cost us $60,000. The accumulated depreciation is $49,000. Don't worry about this 41 plus 8 for some time. It's $49,000, right? The book value then of the date of disposal is $11,000. So that means that what? Proceeds is $11,000. Proceeds from the sale are $16,000. I have a gain, don't I? Now you're saying, well, wait a minute. Then you should have taken more depreciation. You shouldn't have taken so much depreciation. Hey, it's an estimate, isn't it? And I don't know for sure what it's going to be worth when I sell at the end. So I do my best to come up with a salvage value. But if it's different, I'll catch up for it at the end by taking a gain, right? Okay. So I go ahead and I debit the cash, debit the accumulated depreciation to get rid of that, and I credit the equipment to get rid of that, and then I go ahead and I put in my gain. If I'm doing this question on your exam and I ask you for the journal entry or something like this, what I would do, guys, is I would first credit the equipment, because you know you're getting rid of the equipment, aren't you? Then I would go ahead and I would debit the accumulated depreciation, because if you're getting rid of the asset, you have to get rid of the depreciation, don't you? And then what? And then I would debit the cash. You know cash is coming in. Cash is your favorite asset. You know you have to debit it. And then I would sit here and do the what? The line item for the gain last. That's the last thing I do if I'm asking you for a journal entry on this, because we're going to have limited time for the exam, and you can get points for what you put down correctly, right?
How do you know that this is
Oh, I don't know.
you didn't know that?
Okay. Huh? I want, somebody may want to mark you wrong when you said equipment versus, office equipment. I could care less. As long as you're debiting an asset, you're crediting the asset. You're crediting something. Yeah, well, leave yourself a little room so you can put your debits up there. But when you're writing it down, to me, I have a saying, free your mind, your ass will follow. Okay, so what happens? If you sit there and the credit is obvious, you credit that, now you've cleared that brain space to do what? To think some more. Okay, got to get rid of the accumulated depreciation. So you kind of put the journal entry together that way. You don't always, because what a lot of times, especially when you're taking a test and when you're learning, remember guys, I teach the CPA exam, so I talk a lot and think a lot about how to get points quickly, okay, because the exam, you only have 4 hours and you've got all those questions you have to work. So I'm always thinking about how to get points quickly. And my point is, if you sit there frozen because you can't think of the debit, meanwhile, the credit is a piece of cake. Put down the credit. That's all right. Leave yourself a little space and then you can write your debits on top of it. Okay? Okay, good. Now you come over, and in this case now, they sold the office furniture for $16, and assume instead of selling the office for $16, they sold it for what? For $9 now, right? So the proceeds are $9. So again, $60 was the cost, $49,000, $11,000 the book value. Proceeds from sale is $9. We have a loss, don't we? We have a loss. So again, the way I would do this is I would first get rid of the equipment for $60. Debit the accumulated depreciation for $49, Debit the cash because you know you're getting $9,000 cash, and then what? The last thing you should worry about is the gain or loss. Okay? Intangible assets. This is a tangible asset. This is an intangible asset. This is the patent to the touch phone. Which would you rather have? This or this? Well, I mean, look, if I said the whole planet is an asset, you'd rather have the whole planet of this than to say the whole planet, right? So it's not the fact that it's intangible, it's what I described this intangibility, right? Which is what? The patent to the touch screen on the iPhone, whatever, right? Okay? So it's not the fact that it's intangible, but it's what it lets you do, right? Develop iPhones. That's very valuable, isn't it? Okay, so they call it intangible because you can't really feel its value by touching it. Its value is in what it lets you do, right? So if it's what? If it's a copyright, it lets you... Who has the copyright to all the Beatles songs now? Michael Jackson or something, right? That's worth... No, these songs, this is Blanket, I guess that's the... What's the weirdest kid, Blanket? I guess that's the what? Has the rights to all the Beatles songs now. That's very valuable, isn't it? Okay, now what happens? Patents, franchises. What happens here? If you have the right to hang up the golden arches, will people come to your business? Yes, they will. Okay, you look at that movie. What is it? The Fifth Element. Huh? Don't they have? They're flying around in the air, but what? They have a McDonald's in that. Okay, so the idea is what? McDonald's will go on forever, right? Okay, so you have these different types of intangible assets. Trademarks. If you have the right to put that little N with a Y on top of it, or I don't know what's on top of which. The N is the N on top of the Y, or is the Y on top of the N? Okay, what? The New York Yankee logo. That blue hat that was only worth $2 is now worth $27.50, right? Okay, so copyrights have value to them, don't they? Okay, so all of these things have value. Okay, now when we look at our intangibles, we can have a limited life, which means we have to amortize them. You could have indefinite life intangible. Classic example of indefinite life intangible is goodwill. Goodwill, who knows how long it's going to go on, right? Could go on forever, okay? So you would not depreciate, or I should say amortize goodwill. Okay, now patents have a what? We are going to capitalize those, and we're going to put them on the balance sheet, and then we will amortize them over a period of 20 years, okay? 20 years is the maximum life. Can there be a shorter life in 20 years for a patent? Yes, there can. If you have the patent to the flip phone and you invented that, 10 years ago, sorry, it's over with, right? Nobody cares anymore, right? Okay, so when we first came out with it, when I moved, I was going through my stuff and I found my razor phone. You guys ever see the razor? And I remember when I got that thing, it was, I got a razor. Beautiful, right? And so what happens? Now when you look at it, it's a piece of junk, isn't it? Okay? And so what happens? If the patent is only going to give you value for a period shorter than 20 years, then you use shorter than 20 years. The maximum is 20 years. Now, we talk about expensing research and development. Most research and development crashes, doesn't it? Most research and development goes nowhere. So what happens? They tell us that any money we spend on research and development needs to be expensed immediately. We have to expense it. Okay? So what happens? You're saying, well, what's there to capitalize if you're developing a patent and you're spending all this money to develop, the touch screen or whatever on the phone, but you have to expense it all, then what are we capitalizing and what are we amortizing it? You have to buy that patent from a third party. in order to capitalize it. So I develop the patent, you come and buy it from me, what happens? Now you can put it on your balance sheet and what? And you would have to then amortize it. Remember, rule of conservatism says what? There has to be an open exchange in order for us to take the value of something like a patent, which who knows if the thing's going to work out or not. Okay? So we expense all R&D, and then we would capitalize any amount for what? For purchasing the patent. Now, let's say that you have to go to court and you have to defend your right to the patent. So you go ahead and you purchase that patent from me, and then some fool comes along and says, I'm going to sue you for the right to that patent. And you have to go to court and you successfully defend your right to the patent. You can add that cost to the patent. The cost of successful legal fees can be added to the cost of that patent on your balance sheet. Now, what if you lose the lawsuit? What if you're unsuccessful? You're going to not only expense the legal fees, you're going to write off the patent. Anything you had capitalized up from that point would be written off because you don't have any more value left there, right? Okay? All right, good. So we go ahead, we have this patent, and they believe it has a useful life of 8 years. The annual expense is $7,500. And since they did what? Since they purchased it in June, they just took half a year? So after all that, patent turns out to be the easiest thing in the world, doesn't it? Okay, but remember, you have to do what? Purchase it from somebody else. But then the problem, I said they spent all this money to develop the patent, and then I asked you what's the amortization on it, the answer should be what? 0, because they should have never capitalized it to begin with because they didn't purchase it from a third party, right? If I say in the problem sheet that they spent, we change this and they say that they spent $60,000 to develop this patent, and I continue the problem on with the rest of the information as it is there, and then I ask you what's the amortization, the answer should be what? 0, because what? Because they didn't purchase the patent from a third party. There should have never been an asset there to depreciate to begin, to amortize to begin with, right? I'm saying that instead of saying that I purchased, I say that the company spent $60,000 developing the patent. You cannot capitalize costs that you spend developing a patent. I don't care. They won't let you capitalize that. I don't care. It has to be bought from a second party. The second party then is the one that puts it on their financial statements and amortizes it. So if the company spends $60,000 on developing a patent, so we got company 1 over here. Company 1, company A, whatever, spends $60,000 developing a patent. And that's it right here. They're going to go ahead and they're going to debit expense. In fact, they would probably debit R&D expense, research and development, for $60,000, credit cash. Move so far. So that's expense, isn't it? Okay, then what? Then they sell the patent to company B. Company B would do what? Debit patent asset, the intangible asset for $60,000, and credit cash, wouldn't they? Because they bought the patent from company A. They're the ones that record the asset. Company B is the one that then records the amortization, right? Company A did what? They simply sat there and they call it $70,000, right? But they buy it for $70,000, aren't they? So they're the ones that's capitalizing the patent. The company who bought the patent is purchased. You have to purchase the patent. Money spent developing the patent is what? Immediately expensed, isn't it? Now what happens? I go ahead and I sold it for 60,000, for 70,000, didn't I? So company A is going to do what? Debit cash for 70,000 and credit gain on sale of patent. Now I'm saying gain on sale of patent because I'm assuming that their business is not necessarily developing patents. If it is, it would be a revenue, right? So it depends on whether it's normal course of business or not. But didn't they now report the gain for having sold that patent because they got the cash for it? Okay. So if I told you that they had spent $60,000 developing the patent and then ask you the amortization, answer to that is what? 0. Or if I say how much should they add to the patent asset, answer is 0. If I say what should they expense, answer is 60,000, right? For these people who purchase it, they have an asset and they have to amortize it.
So why do you feel like, why does company A have to sell to company B? Because if company A spent the $60,000 to develop the patent, don't you want to hold on to the patent and not sell it and give it as an asset to someone else?
You don't like $10,000? You got a problem with 10,000?
Yeah, but what if you can make more with whatever that patent holds?
Okay, well, you want me to sell it for $50 billion?
But like, why do they have to sell it? So, like,
Who said they had to?
You did.
No, I didn't. I didn't say they had to sell it. I said if they sold it. Well, come on, guys. There's nothing in this world that you have to sell if you don't want to.
So then how do you account for it if they never sell that patent itself?
You don't. It's an expense and it just sits there. It's a patent that they own and there's no value assigned to it. Did I say we could go? So there's no value to it until you sell it to a third party. That's when you take the value. Now the third party, because they bought it objectively, takes it. And I view 70,000 could be 10 billion what they sell it for. They could use it for a while and develop flip phones or phones, whatever, and then sell it to somebody else later, right? You don't have to. You don't have to sell anything in this world. Okay. All right. Hang on. So let's see, where are we? We're accounting for intangible assets. And so what we're going to do is stop it right there because I've already said all this, right? Research and development is what? Expensed, right? As you expense what? Amounts that you spend developing patents, etc. It's an expense, right? Okay, so we're going to stop Chapter 8 there. Okay, we've said everything we need to on the slides. Next time we will go through the quiz for Chapter 8. We'll go through the practice midterm, which has everything from Chapter 4 and 5, and then the other part that I just put up there is more Chapter 8 stuff. But we'll do that last part after we do the second practice quiz from Chapter 5. So let me say that better. Hang on, guys. It's Chapter 8 quiz. Chapter 8 quiz. It's going to be the practice midterm. It's going to be the other second quiz from Chapter 5, and then the last thing is the part of the practice midterm where I added some additional Chapter 8 stuff. And if we don't get to that, so be it, because we would have just gone through some Chapter 8 stuff, right? But you'll still have those additional questions. Okay, guys, I will see you on Friday. Be on time. I'm going to hit the ground running right at 6 o'clock.
So for our final that's on Wednesday, are we meeting on Friday?
Our final's on Monday. Oh, the final. Oh, I don't know. No, we won't meet after the final. Yeah. There's no. Yeah. So we'll have it. I mean, the only thing I could see maybe might push it to that Friday. If we start to run out of time or something. We've kind of been moving the times for the tests around. Do you have something else happening?